post-Powell hangover as investors recalculate the Fed's economic calculus. Live from Washington and New York, this is a special edition of The Close. I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking you off to the closing bell here in the U.S. And Romaine, it's not too pretty.
Yeah, not pretty at all. A third straight day of declines for major U.S. equities, coming off the back of that big Fed meeting yesterday here. But we should point out that this sell-off is global in nature. It started yesterday here in the U.S., picked up over in Asia, where we saw Chinese stocks actually suffering their worst day that they've seen in about 7 weeks. And then that fed into what we saw in the European markets with the stock 600 also down significantly, more than 1% here on the day. We should point out everyone right now focused on what we're seeing in the yield space with that 10-year yield now scraping at around 4.5%, still camped out at the highest levels we've seen going back to late 2007. Flip up the board real quick here because I want to talk a little bit about some of the market sentiment out there. We have the VIX elevated, something that we haven't seen in quite some time, at one point flirting with 17. And when we talk about some of the individual stories out there, you have Tesla, the biggest volume mover of the day, but that's to the downside. Splunk, that's your biggest percentage gainer on the day. But remember, that's largely because of M&A activity. And you take a look at TKO Group Holdings, one of the big batch of new issues that we've had in the market over the past week. And well, it's not doing well at all. Remember, the reference price for this stock right around 102, trading today at 88. That's the cross-asset story right now, a cross-asset story, Katie, that's dominated right now by Jay Powell and the message he gave yesterday.
Absolutely, and he delivered at least one clear message yesterday: higher for longer. You take a look at so-called real yields, which are, of course, adjusted for inflation. He said they need to stay sufficiently restrictive for some time to restore price stability. Now, we heard a similar message from the Bank of England this morning, which held rates steady, but it made clear that the job is far from finished. And of course, those are just two of the multiple central banks that are out with policy decisions this week. We'll preview the Bank of Japan's decision, which of course is coming up tonight. And it's a big week for monetary policy and a big week as well for the media world. Breaking news this morning that Rupert Murdoch, he's stepping down as chairman of Fox Corp and News Corp. That, of course, is the global media empire that the 92-year-old founded nearly 7 decades ago. He hands the reins over to his son, Lachlan, who will take over as the sole chairman of News Corp, in addition to his roles as executive chair and CEO of Fox. Now, elsewhere in the industry, the Writers Guild and the major Hollywood studios said that they would meet for a second day, which is potentially a sign that these two sides are inching closer to a deal to end the months-long strike, which, of course, is just one of several strikes underway in a still tight labor market. And data this morning confirmed that. You had applications for U.S. unemployment benefits. They fell by 20,000 to the lowest level since January last week, showing once again, Romaine, that this jobs market is still hot.
Yeah, certainly still hot, and that is the big topic of conversation as everyone really tries to assess what the Fed might do next. Kathryn Ann Edwards is an independent economist and economic policy consultant, formerly with the RAND Group, joining us right now in our studios here in Washington, D.C. And Kathryn, we're coming off of yesterday where there was so much talk about the Fed's fight against inflation and the idea that they've made all of this progress without necessarily damaging the labor market, at least not in any sort of meaningful way.
I mean, I think it's a magnificent, if, as they noted, tenuous accomplishment. We can't say that we're one and done. We can't say that the fight is over. I mean, I think his approach that we need to wait and see means that we are on good ground, but that does not mean we can stay there.
When you look at the unemployment rate, 3.8%, most economists expect that rate to actually go down a little bit more over the next couple of months before it maybe starts to tick up here. Even the Fed's projections seem to suggest that the unemployment rate will remain below 5% here. Is that a labor market to you that is also healthy based on that headline number?
Based on the headline number, I mean, I would be pretty bad labor economist if I didn't say under 4 is really good, and just about 4 is something I'd be grateful for, especially after 14% just a few years ago. But there are a lot of structural weaknesses in the labor market, and, you know, I think something that Jerome Powell doesn't say is that their dual mandate of unemployment, he has a lot fewer levers on the unemployment side because he doesn't control labor supply policy. He can't directly influence labor force participation. And those are presenting some headwinds and some structural issues that are a challenge to Fed policy.
And Kathryn, when you think about that dual mandate, both the labor market and, of course, price stability, it seemed, listening to Powell yesterday, that price stability is still the more urgent side of that mandate. Was that your takeaway as well?
I think it's certainly the more pressing issue if you compare price growth to unemployment at the moment.
And let's talk a little bit, too, about the fact that wage pressures and wage increases for a long time, they were underneath inflation, that on a real basis, workers were seeing negative wage growth. It seems like maybe we're starting to see that dynamic shift a little bit. But when you look out into the future of wage increases, what do you see?
You know, we're in the middle of a 20-year decline in U.S. labor force participation that has been ushered in by the baby boomers aging out of the prime age and heading into retirement. Overall labor force participation was 67% 20 years ago, and it's 62% now, and we're pretty grateful for the number that we have. Now, the U.S. economy added 3 million workers between this summer and last, and that has greatly helped. You know, any time that you have an inflation fight, you are always looking for ways to expand supply in both goods and services as well as workers. That has helped enormously in keeping us in this kind of soft landing. But we will run out of workers at some point if we don't have a labor supply policy to bring more in.
Talk a little bit more about that policy, or where some people would say lack thereof. You were actually just on Capitol Hill yesterday testifying primarily about childcare and, more importantly, some of the childcare tax credits, which are effectively no more.
So the U.S. Congress stepped in through the American Rescue Plan Act to authorize emergency funds to prop up the child care sector in the wake of the pandemic. It was hit incredibly hard. They lost 1 in 3 jobs in a matter of 2 months. That funding expires on September 30th, and come October 1st, we're not going to see chaos in the child care sector. It's going to be a really diffused impact, but we are basically taking a market that is in failure, has been in failure for some time, and we are cutting off federal funds. Estimates are that we could lose 1 in 4 child care spots in America through firm closure.
But even though it's diffuse, though, I mean, we talk about some of the structural issues in this labor market. You cited the labor force participation rate, how little it's budged here. And we know that we're sort of at this precipice with the older generation moving out of the labor market and a younger generation that does not necessarily have the same numbers to match what the baby boomers and even some of the millennials brought.
Exactly. I mean, this is, if you think back to the prior inflation fight of interest when we're talking about 1980s, I mean, in the 1980s, the baby boomers were quite young. And the labor market was almost of a secondary concern because if you laid off a bunch of 25 to 35-year-olds, they were all going to work again. Now we have a very disproportionately large elderly population. And if you lay off a bunch of 60-year-olds, there's a big chance they're not going to work again. It's a very different kind of response to labor market shocks now that you have a proportionally aged population. And the same is true on the entry side. You know, these labor supply issues, we didn't have to worry about prime age labor force participation when women were doubling their ranks between 1950 and 2000. And the baby boomers were in their prime age. But it's a real concern now, and we haven't shifted policy to meet that. I mean, what I worry about most is, this example of child care funds that are expiring on September 30th. I mean, we've got some really good evidence that up to 3 million child care spots are at stake. That could be 3 million workers. The same 3 million in number that we've added over the past year are now at risk of being pushed out of the labor force. There's no action on it. Yeah. And so this idea that labor supply is secondary or not important to things like inflation, I think it really requires people having the same kind of mind shift of we can't take labor supply for granted the way that we were able to for, 60 years.
All right, well said. Going to have to leave it there. Great conversation here with Kathryn Ann Edwards, economic policy consultant, helping us kick you off to the close here on this Thursday afternoon. Let's stay in the world of central banks here. We got the big Fed decision yesterday, but this is among about 11 big central bank decisions that we're getting just in the span of less than 48 hours. Michael McKee is standing by right now for us here, actually in the studio. Great to see you in person.
Yes.
Once again here. I guess a little bit of a holdover from the Powell press conference, but you woke up this morning, you had the BOE, and in a few hours' time, you're going to get the Bank of Japan making a decision as well.
It's a kind of the Glastonbury Festival of central banks this week, where you got a lot of bands playing, some more important than others. The Fed obviously was a headliner. The Bank of England wasn't supposed to be the headliner, but they made a lot of news today because they surprised the markets by not moving. They held their rate steady and suggested that they have a bias to raise rates again. But at this point, there's a feeling among a lot of investors that they're not going to, that this may be the peak for the British. If the inflation rate continues to go down as it did yesterday, then we may not see them move again. But if you were going to pick anybody to move, it would be not the British, but the Bank of Japan. As you mentioned, they meet tonight.
Yeah.
and probably not going to do anything. But there is an increasing number of bets on the idea that the Bank of Japan, either this meeting or sometime before the end of the year, will raise rates for the first time in about 6 years, 7 years. They've kept rates at negative. Their benchmark rate at negative 10 basis points for that long because inflation was nowhere near where they wanted to be. It was negative for such a long time. Now they're up to about 3.3% on the CPI. And according to their forecast, they expect it to last into next year. So according to Kazuo Ueda, the new central bank governor there, the Japanese may be at the point where they want to start thinking about raising rates. That's separate from the yield curve control issue.
Oh, okay.
Which is also on the table, apparently, where they just buy unlimited amounts of 10-year notes to keep the yield down. But they may be starting to move monetary policy there for the first time in a long time. So a lot of interest in what's happening in Tokyo overnight.
And Mike, just to crystallize that point, we could see a move from the Bank of Japan maybe by the end of the year, but it sounds like yield curve control, if I'm understanding you correctly, might be a longer-term story.
Well, one of the problems with getting out of yield curve control is that they've kept rates low for so long that the government has spent a lot of money stimulating the economy and building infrastructure. And the same problem we have here when yields go up, especially if they go up quickly, it's going to cost the government a lot more money. So there's been some reluctance to do that. And they're trying to figure out a way to do it very slowly. They've widened the band a little bit. And the idea is to slowly get out of it without causing a big market disruption. But that may be easier said than done.
Michael McKee, our Bloomberg International Economics and Policy Editor here in D.C. on the back of a big decision yesterday by the Fed, a big no decision by the BOE today, and the Bank of Japan up next. Coming up here on the show, we're going to take a look at Cisco's deal to buy Splunk, $28 billion, a massive push into software and AI-powered data analysis.
Plus, we'll hear from our interview with Darrin Williams, Southern Bancorp CEO, and get his insight on the impact of higher interest rates on the financial sector.
And we heard from Michael McKee and that exchange with Jay Powell yesterday about a soft landing. Jim Zelter, co-president over at Apollo Asset Management, says he's skeptical of a soft landing. That conversation and so much more coming up in just a bit. From Washington and New York, this is Bloomberg.
This is the countdown to the close, and Wells Fargo expects the S&P 500 to rise to 4,600, expecting a bullish run on the back of the Fed hitting the brakes on the rate hikes and, of course, the flurry of IPO activity that we've seen. And here with his perspective is Charles Lieberman. He is Chief Investment Officer over at Advisors Capital Management. And Chuck, clearly Wells Fargo sees some blue skies ahead between now and year end. Is that your expectation as well?
Well, at the same time, we're also getting economic growth that's better than expected. And that's obviously very positive for corporate earnings. So I expect profits to be quite good, but certainly for the third quarter and also the fourth. And so, yes, higher rates are a headwind, but profits are a tailwind.
What do you think is currently weighing on the market? Because you take a look at the S&P 500, we're still up double digits, but we know that it's been a rocky couple of weeks. What's front and center for the worrywart right now?
Well, what's really driving everyone is, of course, monetary policy from the Fed. The Fed has tightened policy a lot more than the markets expected, and they keep on warning us that rates may need to go higher. Certainly, they're telling us higher for longer. The market is very concerned about that, and that's the thing that holds it back. It's certainly what causes these meltdowns of short order. For example, today and yesterday, the market is very concerned about that. But at the same time, the economy is holding up very well, which is why rates are going up.
Well, that's what I'm curious about, Chuck. We talk about the fight against inflation, how much progress has been made with the headline inflation below 4%, even core now starting to approach that 4% level based on some measures here. Even if you do maybe get an acceleration or reacceleration in some of those numbers, is there any sense that it would be severe or material, or are we just talking like a fraction of a percentage point?
Well, it could be sizable. The odd thing about the labor force participation rate, which was discussed in the previous episode, it's gone down significantly over the last 5 years, but it's up meaningfully over the last 12 months. And that's really quite odd. And if not for that, the unemployment rate would be lower, would be below 3.5%. Also, job growth remains very strong. It's slowed again, but it's slowed down from really, really ridiculously strong to excessive. Imagine trying to explain to a traffic cop that you don't deserve a speeding ticket because you just slowed down to 100 miles an hour in a 70-mile zone. That's what the economy is doing. The labor force trends should be producing roughly 50 to 100,000 new entrants into the labor market every month. And we're really running 50% above that, roughly 150,000. So the labor market is still very tight and behaving a little oddly. And if labor supply slows down, we're going to have upward pressure, significant upward pressure on wage inflation.
I'm curious as to what the net effect ends up being on corporate fundamentals, because so far, most companies seem to have found a somewhat of a sweet spot here, being able to absorb some of those higher labor costs, passing some of those costs on to the consumer. But we're now starting to hear from some of those companies that that balance that maybe they had a few months ago isn't necessarily quite there anymore.
Yeah, well, productivity is a saving grace. To the extent we can get a lot of productivity, I'll take all of it that I can possibly get. But productivity is hard to forecast. In fact, I would say almost impossible to forecast. And it's been running pretty well, but it may not be sustainable again. The underlying trends probably suggest roughly 1% at an annual rate. So if wage rates continue at the 4% or higher rate, it's going to be very hard to bring inflation down below 3%.
And Chuck, we don't have much time left, but I want to talk specifically. When you look under the hood of the S&P 500 at a sector level, maybe at an individual name level, where do you see the most opportunity against that backdrop?
Well, in the context of what I was talking about, everything that's interest rate sensitive is concerned. So I'd be cautious about utilities. I'd be cautious about long-term bonds. I'd want to keep my duration below the benchmarks. Consumer staples, because the multiples are high, are a little bit at risk. Certainly technology stocks with high PE multiples are at risk. And I really like some of the more economically sensitive parts of the economy. Energy is very attractive. I think housing has a shortage. That's still very solid, has excellent prospects. So there are plenty of opportunities in this market.
All right, Chuck, great to catch up with you here. Chuck Lieberman there, a lifetime of experience from the Fed to Wall Street, and of course now at Advisors Capital Management, the CIO and founder there. As we continue to kick you off to the close, we're going to hear from the interview that we had with Jim Zelter, the co-president of Apollo Asset Management, speaking at the Bloomberg Credit Conference. We're going to hear what he has to say about the prospects for a soft landing. That's coming up next. This is Bloomberg.
Well, the debate over a soft landing took center stage today as the co-president of Apollo Asset Management spoke at the Bloomberg Global Credit Forum in London. Jim Zelter was asked if the Fed's tightening measures are having the desired effect.
The mechanism, the transition mechanism, which the Fed would like to see in slowing down the economy, which we all expected, it's taken a lot longer. In the U.S., you have a mortgage market with 30-year mortgages at a 3% interest rate. You have the high yield market with a 6% coupon and an 8-year duration. So the real impact of higher costs around the globe in the U.S. and Western Europe, it's not been felt yet. And so when people say, well, we're going to have a soft landing, I'm skeptical. I see a world where financial conditions have gotten tighter, and it's just a question of how long that transition mechanism, which will probably be longer than it's taken in the past.
There are a couple different ways for us to get to something other than a soft landing. There's the crash and then rates going back down. And then there's something where it's just sort of a stagflation light or a stagflation proper, where rates remain high for a very long time and growth just slows substantially. It seems like the market is leaning into the latter. How much does that change your perception of what's going to happen in the credit space?
Well, this conversation is going into one where we need to get Torsten here because he's the economist at Apollo, not me. But certainly what you're talking about is an environment where growth is more challenged, and with, how do companies access capital with a new price of marketplace? Certainly you have challenge, whether it's in Germany or in the UK, with a slowing economic growth. But there's a variety of aspects that we would see. Unemployment, while still very low, it's going in probably a more challenging direction. Delinquencies are going up. Defaults are going up a little bit in the leveraged loan market and the high yield market. Recoveries are lower. So there's a lot of points that would say to you that there's going to be a more challenging, tightening financial conditions. But certainly for us, the U.S. has been quite strong. The U.K., there's still a lot of areas to lend. There is on Western Europe as well. So I guess the theme that I would take away from this is that we're going from a decade of a real imbalance where the equity was the big beneficiary, debt paid a crazy price. That balance has been completely changed 180 degrees. And now, how do companies navigate? How does the financial services, how do banks, how do alternative asset managers, how do we all balance and navigate this marketplace ahead of us?
Is this the return of the bond vigilantes then?
Well, I do think when people talk about, when the central banks are going to actually lower rates, I think it'll happen well before they actually get around to it, just like it happened on the upside in terms of rates. There's no doubt that one of the challenges of the last 15 years of the regulatory environment is you've had so much capital withdrawn from these marketplaces in terms of trading desk capital. So the amount of capital to trade $100 or $1 billion of 10-year treasuries right now, that has a greater impact. So there's no doubt that any kind of activity in the secondary markets will have a pronounced impact.
All right, Jim Zelter there, co-president of Apollo Global Management, speaking a little bit earlier at that Bloomberg Credit Forum out there in London here with team surveillance. We come back here to the broader markets here and abroad, and it is a down day worldwide on the back of some key rate decisions by the Fed as well as a few other central banks. A signal here, not only that rates could be higher for longer, but more importantly, how it dovetails with economic conditions, causing a little bit of a re-rating in stock prices. Down 1% on the day for the S&P 500. Elevation in the middle of the curve, particularly when it comes to the 10-year yield, and the VIX starting to perk back up, something that we haven't seen in several weeks. Stick with us. Romaine Bostick here in Washington, Katie Greifeld in New York. This is Bloomberg. This is the countdown to the close. Katie Greifeld there in New York. Me, Romaine Bostick, here in Washington, D.C. Almost 2:30 here along the eastern coast of the United States. Broad moves that we're seeing in the broader market. Also seeing some pretty significant moves in commodities right now. Abigail Doolittle standing by with our commodities close.
Indeed, Romaine. Similar to U.S. stocks, we do have the commodity complex lower. The Bloomberg Commodity Index down about 1%. And, of course, the stronger dollar is weighing. You can see that crude oil, which actually had been higher, just a little bit higher not so long ago, down ever so slightly. Natural gas, though, down much more, down 4.5%. It's not clear what's really behind that. That's true for copper, too, down 1.9%. Wheat, down 2.25%. Wheat on the year down nearly 30%, more than a bear market, really bearish action there. And people are expecting from a stockpile report supplies to increase. So I think that the overall theme here, though, is we have another area of risk assets selling off, similar to stocks, after yesterday's higher for longer hawkish pause Fed meeting.
All right, keeping an eye on the commodity space. Abigail Doolittle there. Meanwhile, we want to go back to the labor market and some of the strikes, particularly what's been going on in Hollywood. We're learning that there has been some progress with regards to the writer's strike, now in its 5th month. Chris Palmieri is joining us right now, our reporter out in our Los Angeles bureau. Chris, this appears to be day 2 where we've had pretty much the heads of the union and the heads of some of these major studios sitting down. From the outside looking in, that would seem to suggest that progress is being made.
Indeed, yes. From what we understand, Disney's Bob Iger, Netflix's Ted Sarandos were there yesterday. The studios presented the Writers Guild with some more proposals. This has been ongoing. And there was quite a few months this summer where they didn't meet at all. They reconvened in mid-August and have been sort of meeting intermittently. But they decided to talk again today. We're told the Guild is going to come back to the studios with some counter proposals. They're not as far apart as they used to be, and so while a deal isn't imminent, it's likely to come in the next few days.
So, Chris, they're not as far apart as they used to be, perhaps, but where does distance still remain?
One of the issues is whether writers are going to get compensated based on the performance of their shows, basically how many people watch on streaming services. There was a proposal the last time around from the studios that they would share a little bit of information with senior people at the Writers Guild, but not widely distribute, say, how many people watched a show on Netflix. Another big issue has been minimum staffing of writers. The Writers Guild has been asking for, say, minimum of 2 people, for this many days. The last proposal from the studios was that it be up to the senior writer, the showrunner, to decide whether or not he or she needs a minimum staffing level.
All right, Chris, really appreciate your reporting. As always, that is Bloomberg's Chris Palmieri. And staying with the media sector, Rupert Murdoch is stepping down as the chairman of Fox and News Corp following a nearly 7-decade career. He will become chairman emeritus of each company, and his son, Lachlan Murdoch, will become chairman of News Corp and continue as executive chair and CEO of Fox. Joining us now with the details is Bloomberg's Jerry Smith. And of course, Rupert Murdoch, 92 years old. Maybe this wasn't surprising that eventually he would step down. Is this succession plan broadly what had been expected?
I think so. I think most people, investors, had expected this. He had really settled the succession question a few years ago when he sold most of his entertainment assets to Disney and then appointed Lachlan to really run Fox. So this really formalizes what was already in place.
Yeah, I mean, certainly this has been a long time coming, Jerry. I am curious, should we anticipate at all any significant changes under the new leadership here? There's been so much talk, obviously, not only about the heavy hand that Rupert had, but of course, I guess the sense of politics that he injected into a lot of the programming. Does his son share that same vision?
Yeah, I think that Lachlan is, really sees the world the way that his father does. I think that was why he was, given the role that he is, and I think he communicates still with his dad. So I don't think there's an expectation that Lachlan's going to take the company in a dramatically different direction.
And of course, we're talking about a global media empire here. Just put that into context. When we talk about the Murdoch empire, what exactly are we talking about?
I mean, it's really on 3 continents. This was something where Rupert took a newspaper that he inherited from his father and built out an empire, not just in Australia, but in the UK and in the United States. United States, he did some really ambitious deals. Fox, the broadcast channel, got NFL rights, which really helped that. He also owns the Wall Street Journal through News Corp and several other newspapers. So it's really a sprawling media empire, but it is a lot smaller than it used to be because of that Disney deal where he sold off a lot of the entertainment assets to Disney.
All right, and of course, the big question, Jerry, I think everybody really wants to know here is how, if at all, is this going to disrupt the next season of Succession?
Yeah, I think that fans of the show are particularly intrigued by what's going on here. And the other thing to point out is obviously we got a 2024 presidential election. Rupert Murdoch has always been known as a kingmaker in Republican circles. So it'll be interesting to see how this plays out over the next year.
All right, once the strike is over, get the writers back in a room. Let's get cracking on a sequel. Hopefully someone's watching who can make that happen. Bloomberg's Jerry Smith. Thank you so much.
They're all watching, Katie. They got nothing else to do.
That's true. That's a good point. Well, stay tuned in because still ahead on the close. Peak cruising season, it may be over, but analysts are signaling that now's the time to get back on board. We're going to talk more about the growth potential in the sector next. This is Bloomberg.
All right, let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And we start with CrowdStrike. Executives at the cybersecurity company spoke at an industry conference and later gave a briefing to investors and analysts. They like what they heard, particularly when it comes to cash flow and margins. Wedbush, among at least 5 analysts raising their price targets. Wedbush going to $200 a share from $170. That implies a 35% gain for the stock over the next 12 months. Unfortunately, those gains not starting today, down 1% on the day. Next up, International Paper getting to upgrade over at Truist Securities to buy. Truist saying that the container board market is actually reaching a positive inflection point, which should lead to significant demand improvement after several, quote, dismal quarters of inventory destocking. Shares of International Paper up about 1% on the day. And finally, let's take a look at Frontier Group. Interesting downgrade here to neutral over at Citi. The price target actually hacked all the way down to a street low $5.50 a share. The analyst basically saying he's not too keen on the airline's recent comments about seasonal weakness. And then when you couple that with some of the weak December booking curve data, not good at all. Nevertheless, those shares bucking that downgrade here on the day, moving higher by about 1%. Those are some of our top calls. We do want to say, though, in the travel space here and in the sell side space, and talk a little bit of why some analysts are bullish on cruise operators. Redburn recently upgraded Carnival and Norwegian Cruise Lines for the sector's post-pandemic recovery story. Pleased to say that we're joined right now by Alex Brignall over at Redburn Atlantic. Let's talk a little bit about, I guess, what is driving that optimism here. Is this strictly about the numbers in terms of the number of people getting on the ships? Is it about the pricing power or something else?
Sure. Thanks very much for having me on your show. I guess the big thing that everybody that's in travel is pricing. If you look at the hotel, the leisure sector in general, you typically see relatively well correlated pricing. So if you go back for 20 years before COVID, you will have seen hotel pricing on the leisure side and cruise pricing run pretty much in lockstep. Through COVID, what we've seen is that the gap has opened up from about 20% to 40% in terms of pricing, the pricing differential. And we think that that's going to close as we go through the next couple of years.
So this now becomes sort of a relative play. So for investors who maybe want that exposure to the travel sector, want that exposure to whatever we're calling it now, revenge travel or what you will here, is the idea that the benefits or I guess the advantages that the cruise industry might have now, that is something that will be lasting?
Sure, I think you've explained it well there. I think what you need to consider is how long does it take to sell a cruise? If you're selling a hotel, the booking window is a couple of months, 2 or 3 months. If you sell a cruise, it's 18 months. And that has a very significant smoothing impact on pricing. So if you consider that a cruise sailing today would have started selling 18 months ago when restrictions were significantly higher, then obviously it's going to have a dampening effect on pricing. So as we go through that process, move forward over the next 18 months, what we're going to see is that pricing will improve simply just through the passage of time as we have a higher proportion of the tickets having been sold, further out away from COVID, where pricing has been higher. And we think that that will lift pricing back to where the pricing that's been achieved in the hotels. And you've seen it in some areas. So the Caribbean has a shorter booking window. If you're taking a 4-day weekend cruise in the Caribbean, the booking window for that is going to be much shorter. Royal Caribbean, is the most exposed to that area. They've seen the best pricing simply as a consequence of that booking window being shorter and them being able to sell all of the rooms at a higher price. As the others who take longer to sell, if you're going on a 2-week cruise in the Med or to Alaska or the Nordics, that cruise is going to take a longer time to sell. So over time, you're going to see pricing just improve as we see a greater proportion of it sold whilst confidence is high.
And Alex, looking through your notes, you make the point that COVID in particular diminished the role of travel agents. Why is that helpful for the industry?
Yeah, I'm as careful as the cruise lines in kind of talking about diminishing the role of travel agents. They are an absolutely integral piece of the business. If you think about the typical, cruise booker, maybe they're not as tech savvy, maybe they're a little bit older. They need help, and also it's a product that people take less frequently, and it's more complicated than going to a hotel. So I think the travel agents will be immensely important, and it's a growing industry. So there's certainly plenty of space for the travel agents to be involved. What you saw during COVID was a significant move to online. And what we talk about in the note is that when an industry is consolidated and when you spend a significant time enjoying that product, then people become attached and become loyal to the booking system of the direct travel. So I've talked about the impact on the hotel space, and what you see there is that the OTAs tend to take a lot of share because the hotel market is very fragmented. The top 4 cruise lines in the world control 85% of the product. So when people move online, you're typically going to see that traffic, those bookings, accrue to the cruise lines themselves rather than to travel agents. It's not to say that the travel agent role will become less important. It's that as people are more comfortable booking online, then potentially they move towards booking directly. That has beneficial impacts for the cruise lines and selling advanced sales, selling onboard packages. And as you alluded to, helpfully, 29% of cruise revenues in 2019 was spent on some sort of distribution, so be it commissions or marketing. That's twice as high as any other travel subsector. So there's obviously significant savings that could be made in the passage of time.
Okay, so don't call time on the travel agencies, but of course behaviors did change during COVID. That's the case for many industries, of course. And Alex, we don't have too much time left with you, but looking into the specifics of your call, you upgraded Carnival, you upgraded Norwegian. Why these 2 stocks in particular?
Yeah, I think it's a good question. It's one that I've had a lot. Look, I'll never say a bad word about Royal Caribbean. It's a phenomenally run business. But as I sort of alluded to a little earlier, what you've seen is they've had this tremendous benefit from their exposure to the Caribbean sailing market, which has obviously recovered very, very fast. The other areas have recovered a little bit slower, be it Europe, be it Alaska, be it Asia. Those are the areas where Carnival and Norwegian have more exposure, and those are the areas where the booking curve is longer. And therefore, you kind of need more of the passage of time to be able to see prices increase as Carnival and Norwegian are able, to sell their products at a higher price. And as that happens, I think the gap in pricing between Royal, which has done a superb job thus far, and the other 2 will close a little bit.
All right, Alex, great to catch up with you, and great research. Alex Brignall there over at Redburn Atlantic. A closer look here at some of the cruise line operators, down today, but still having a phenomenal year. Royal Caribbean, which he was just talking about, up 90% year to date. Coming up after the break, a conversation with Darrin Williams. He's the CEO over at Southern Bancorp. We're going to hear what he had to say about how higher interest rates might impact small businesses. That conversation coming up next. This is Bloomberg. Welcome back to The Close. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, had a chance to catch up with Darrin Williams. He's the CEO of Southern Bancorp, and they discussed his concerns about higher interest rates and how it's impacting his customers. Take a listen.
It's starting to put a little pressure on some of our customers, particularly our small consumer borrowers and some of our small businesses. As we have our loan portfolio is pretty short in nature, duration, so about 20% turns over every year. Those small businesses that got loans, 3-4 years ago, they're now having to refinance that loan, and rates are quite a bit higher. And so that puts a lot of pressure on them to be able to make that payment that's significantly higher. And so really concerned. Asset quality is strong right now, but I am concerned about these rates stay long for a long period of time, stay high for a long period of time. Are they going to be able to make it?
Is there also subdued demand for new loans?
Yes, so we still, and I give just big thanks to our team. They're out working, and our loan demand is still pretty strong. But I do think that you'll start seeing that turn down. Those particularly small businesses that can wait, they're telling us, well, I'm going to wait and see if these rates come down next year. But right now, loan demand still remains strong. But I do think you'll start to see pressure on that as we continue to have these high rates.
When you have the loans that are coming up, they're already out there, you have to be refinancing. Are people defaulting? Are they're putting off the payments? What are you experiencing?
Yes, so again, our asset quality continues to remain strong. I think on a $1.5 billion loan book, I looked, excluding our non-accruals, we only have about 20 basis points of people who are past due. Where we see the pressure is we see small consumers who have borrowed just a small amount of money. We do a lot of small loans. So we did last year almost 8,000 loans, 750 million in originations, and 54% was less than $10,000. And so that's the plumber who needs a wrench. That's the mom who needs to buy school clothes, whatever it might be. We're starting to see a little uptick in past dues among that crowd. Not our larger small businesses. They're doing okay right now, but over time, I'm still concerned about them as well.
What are those small businesses seeing from the consumer? Are we starting to cut back on some of the consumer demand? Because that's actually how they generate their money and their jobs.
Well, what you're starting to see more and more is consumers are really extending themselves from a credit standpoint. They're putting more and more necessities on a credit card. So I think there's a day of reckoning coming here. So I'm really concerned because all the stimulus has washed its way throughout the, through the economy, and at some point in time, people are going to have to pay those bills. So I'm really concerned about how much people are putting on credit. But again, right now, things remain strong, but I am concerned about the long term.
What about the cost side of your business? Are you paying more for deposits?
Absolutely.
Because rates have gone up, and how much of a squeeze is that putting on your business?
Yeah, so from August 22 to August 23, just 1 year, we seen a 125 basis point jump in our cost of funds. So we're feeling the pressure, and banks are competing. They're competing, strong for deposits. So we're having to pay up for those deposits.
What about commercial real estate? We hear a lot about, some people even call it a doom loop on commercial real estate, because there's a lot of commercial real estate out there that hasn't really been repriced fully yet, hasn't been refinanced. What is your experience with commercial real estate? Yeah, so
our commercial real estate, don't think the big buildings in New York. Our commercial real estate is largely strip centers that are owner occupied. So it may be a strip center, the owner has his business there, or has several businesses there, and so those are kind of mom and pop operations. They're still doing fine. So we're not concerned about what you're seeing, the concern that you hear about consumer real estate being, just having trouble. People again not working from, they're working at home more and more, and so I think there are going to be troubles. But fortunately for us, our commercial real estate is kind of a different type of commercial real estate.
So your Southern Bancorp thus far hasn't turned into a landlord. That is
no,
to say,
not
have
yet.
to take possession and actually have to run some of these properties.
Not yet. Not yet. That's We don't want to be in that business. You're exactly right.
Exactly. So what about your overall mode? I mean, a lot of companies are taking a hard look right now, whether they can expand much more, whether they should actually retrench. Is Southern Bancorp going forward, going backwards, just sort of holding pat?
Yeah, so it's foot to the pedal to the metal. We're blowing and going. We're trying to grow. The CDFI and MDI space got a lot of attention, and we've got a lot more partners, got a lot of support from the government, and so we've gotten, we've raised in the last 4 years probably in excess of $300 million in capital, and that's growth capital, and so we're looking to grow. We are maybe zigging when some people are zagging. We're actually building a mortgage company, and that may be
Yeah, but how does that work? With mortgage rates given where they are, why is that a good move?
Well, here's the thing. So for our customers, and we're serving the first-time home buyer, a lot of minority home buyers, they're not as sensitive to rate as other people. And so the way a lot of the capital we've received incentivizes us to actually make mortgage loans. So we've hired a new head of mortgage, and we're looking to expand in several states outside of Arkansas and Mississippi. And we're going to grow and go there probably first with our mortgage company. The foundation of what we do is about building wealth for families. And a family's home is kind of the foundation of wealth. So we're gonna marry some of our philanthropic supports with maybe some down payment assistance, maybe push some of those rates down, and help families, first-time home buyers, get into homes and help begin to build wealth for those families.
Are you seeing some of the at least mid-sized regionals pull back some, and does that affect your business?
Well, we have several mid-sized regionals that are actually shareholders. They support our work and they get CRA credit for it. So I'm thinking folks like Cadence Bank, like Regions Bank, like Simmons Bank. Those are all banks who've invested in our shareholders in our company, and they are big partners. They are giving us a lot of support, a lot of help. They've not pulled back at all. They're pushing us hard.
Southern Bancorp CEO Darrin Williams speaking earlier with David Weston on our Wall Street Week daily segment. Tomorrow, we're going to hear from Jose Mignana, the CEO over at Nuveen, and be sure to check out Wall Street Week every Friday at 6 p.m. Eastern Time. Here on The Close, as we round into the final hour of trading here on this Thursday afternoon, a look at markets which right now are hitting session lows once again, a complete rethink of what we saw coming out of that Fed meeting yesterday. You have stocks lower on a price basis, Treasuries lower on a price basis, Bitcoin lower on a price basis, commodities lower on a price basis, in fact, setting up for the broadest sell-off we've seen in more than a month. It's almost 3 p.m. here in Washington as well as in New York, Katie. I haven't checked, but I assume we're in the same time zone here. This is the Countdown to the Close. I'm Romaine Bostick.
And I'm Katie Greifeld.
All right, let's get a check on the markets. A view from the top here on what has shaped up to be a rather dour day. Stocks right now around session lows with the S&P 500 at that 4,400 line to start the day now, as you can see on your screen, 43.47, down about 1% on the day. The Russell 2000 also down more than 1%. And all of the major indices right now starting to test to the downside some of those key moving averages. We have been talking so much about those 50-day moving averages over the past few days, the 100-day now in play. NYMEX crude is pulling back just a little bit here on the day, back below $90 a barrel, but your 10-year yield remains elevated. That is where most of the action is on the curve. Spot 4.779 right now here, up about 7 basis points from where we were yesterday. Flip up the board here because I want to talk a little bit more about what we've been seeing in other pockets of the market. We talk about what started overnight coming out of that Fed meeting here, a big sell-off in Asia. Some of that was partly due to monetary policy, but of course some of that also due to economic conditions. You take a look at the CSI 300, and Katie, I'm sure you remember the first month of this year, that index was on fire. But ever since late January, when it hit that year-to-date high, it's down more than 20% here, and a lot of concerns right now about the reopening story in China, and more importantly, whether there's any sort of investor appetite in that part of the world that could provide a catalyst for the rest of the world.
Just one of the big consensus trades to go bust this year. It's going to be interesting to see how the end of the year shapes up for many of those trades. But let's go back to today and let's talk about some specific single name stories in U.S. equity markets. We have to talk about Cisco and Splunk. One of the big stories of the day, Cisco agreed to buy Splunk in a deal valued at about $28 billion. That is its biggest acquisition yet. About roughly 10% of Cisco's total market value. Probably explains why shares are down today right now, Romaine.
Yeah. Were you not a fan of this deal?
I'm a fine fan of this deal. So too are Splunk shareholders, of course. Splunk, if you don't know it, offers data.
Are they going to keep the Splunk name? I mean, when Cisco buys, is it going to be like Cisco Splunk or Splunk Cisco?
My only comment is I hope they get rid of the name Splunk. It's a bit icky. I don't know about it. In any case, Splunk shares are up 21%. Splunk, of course, offers data observability services. That is a difficult word. Allows companies to monitor their internal systems, etc. Let's also quickly talk about Celsius. This is an interesting one. Of course, the energy drink maker. It's up 61% year to date, but it's been having a tough couple of days. Roth MKM saying that the sell-off is unwarranted. It upgraded its price target, but that's not helping shares at all today. Currently down almost 7%, Romaine.
Yeah, interesting price action here in some of those individual names. Katie Greifeld, on a day where, of course, the broader market and the macro conditions continue to dominate. We are 1 hour away from those closing bells. Our cross-platform coverage, counting you down to the close, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the Countdown to the Close. Romaine Bostick in Washington, Katie Greifeld in New York. We're joined right now by our colleagues Carol Massar and Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms as we count you down to the close. Markets really on the back foot here, Carol. An S&P 500 that could not hold that 4,500 level, an elevated VIX, Treasury yields all over the place. But they tell me, Carol, you want to talk about wine.
You set yourself up for that one, Carol. This was your choice.
I did talk to the producers. Listen.
I'm having trouble hearing you.
Listen, you may be down in Washington. Maybe you're meeting with Jay Powell. I don't know. Maybe you're trying to make more sense, digesting, deciphering what the Fed had to say.
I think he wanted to get away from me. I'm not quite sure. I'm lonely.
Never. Nobody would want to get away from you. All right. Anyway. We still have a lot to talk about the Fed. We're going to get into that soft landing idea in just a moment because you guys are actually talking about something of substance. What I want to talk about is Darden coming out, right? Out with their earnings. They did beat, but the company's officials coming out and saying what's happening among their richer clientele, those I think making what? About
$125,000 a year and more.
They're trading down when it comes to what they're drinking, what kind of wines they're choosing.
This is actually
an economic indicator.
It is. It actually is important stuff, and it tells a bigger picture about the consumer. The story that it tells, though, we don't actually know, Romaine. I mean, the company said, okay, maybe some of these people who are trading down could have spent money on traveling to Europe over the summer. We know a lot of people did that, or perhaps the exuberance of 2022. You know, we're beyond that, but. The company says it's not going to make any major changes or do any big discounts as a result of this. They're just saying, hey, we're seeing this pattern, and it might not be with us for the long run.
It's a reminder that the pocketbook is not endless for even some on the higher end of the income spectrum. Right?
Yeah, I mean, I tease you about this, but we speak to Darden a lot and Dine Brands and a lot of these chains here. And I do think it's interesting. They're all they've been saying the same thing. The idea that people are still coming in to eat and to drink, but they're not necessarily buying the more expensive items or buying as much here. And yeah, maybe that becomes the consumer spending story or lack thereof later this year.
Which, of course, feeds into the broader economy and this idea of a soft landing that maybe it won't be so painful, the cost to get inflation down. Of course, we heard from Jerome Powell yesterday saying that soft landing, not the baseline expectation. It was interesting to see this article from some of our Bloomberg Business Week colleagues. You can see that chart there. If you look at media mentions, soft landings, it spiked, I guess that's 2002, 2003. It spiked, I would imagine, around 2007 or so. It's spiking now, but those yellow bars that you see, those are recessions around this current spike that we're living through. I don't know, maybe we'll see another yellow bar. Maybe we'll actually pull it off.
I guess. Can you do that same chart for us, Katie, but with hard landing instead of soft landing? I'm curious, or maybe no landing. What does that look like?
I don't know. I would love to run this chart on no landing mentions because I'm still trying to work out what that is.
The story makes a really good point, though, that there's a lot happening right now at the exact same time that's out of Fed Chair Jay Powell's control. He talked about some of it yesterday, UAW strike. We have resumption of student loan payments, potential government shutdown. These are all things that could affect whether or not the U.S. sees a soft landing and energy prices spiking. I mean, this is like a quadruple threat.
Here's why we care. Bloomberg Economics, Anna Wong, shows that since the early 80s, consensus predictions that the U.S. economy would achieve a soft landing have peaked right before the economy started to sour. That's why we care. Go ahead, Romaine.
Okay, I care too, Carol. Thank you. No, I got nothing. I mean, you stole my thunder there. By the way, last time I should point out, last time I went drinking with Carol, I think
what?
Yeah, we're not on the same page. But I was going to say, last time we went out drinking, I think Carol ordered like a $200 bottle of wine.
No, actually, I believe you ordered a 200, maybe even two.
Wait, why wasn't I invited to this dinner?
Don't rat me out.
I'm like, I know. I'm like, do you need my credit card?
I don't care who ordered what. I just wasn't there. That's not cool.
Just saying. What happens in restaurants should stay in restaurants, I guess. All right, guys, we're going to be back. Our cross-platform coverage, we're all over the place. We're in New York, we're in Washington, and we're going to be back, of course, on TV, radio, also on our streaming service, Bloomberg Originals, and, of course, on YouTube. Don't go anywhere because we're going to count you down to the close on this Thursday.
Let's continue our markets coverage right here on The Close. A conversation earlier today with Jim Zelter, the co-president of Apollo Global Management. He was speaking at the Bloomberg Global Credit Forum out there in London, and he's saying it's way too soon to call success on soft landing. Take a listen.
When people say, well, we're going to have a soft landing, I'm skeptical. I see a world where financial conditions have gotten tighter, and it's just a question of how long that transition mechanism, which will probably be longer than it's taken in the past.
Jim Zelter speaking a little bit earlier. Joining us right now, Sinead Colton Grant. She's head of investor solutions over at BNY Mellon. And Sinead, I think so much talk right now is think about some of the disappointment, I guess, that the market had coming out of the Fed meeting yesterday. And for that matter, you can do the ECB meeting last week and even some of the rate decisions that we've gotten just over the past few hours. The commentary seems to be the same here, that whatever investors were pricing in for the next year or two with regards to economic conditions, central bankers aren't necessarily on that same page.
Thanks, Romaine. Delighted to be here. Let's just think, first of all, about the tendency for the market in aggregate to get a little bit overexcited about central bank rate cuts. The Fed was really clear yesterday. They're still talking about rate cuts next year, or forecasting them more correctly, but it's 2 rather than 4. And that's really telling us is that the Fed wants to be cautious about when they start to cut. And let's also take a step back, because the economy has proven to be tremendously resilient. We're looking at an economy that's had over 500 basis points of rate hikes over the last 18 months. And really, in terms of economic performance, the US economy is the envy of pretty much every other developed market economy.
Well, we certainly saw that when it came to some of the projections that we've got by some of the other central bankers. Fold that in, I guess, to the global picture, Sinead. I mean, the U.S. economy is doing great. Is there a significant correlation that we should be worried about that if you have other major economies, whether in Europe or whatever the heck's going on in China, that the U.S. investor, the U.S. economist should be worried as well?
So clearly it can be a little bit of a headwind. When we look at what's happening in Europe, you're seeing a very unfortunate combination of stickier inflation combined with rate hikes, slower economies. One of the really big dynamics that you have there, whether it's in the Eurozone or in the UK, is just how quickly those higher rates translate through mortgage rates directly to the consumer. And it's much, much faster than you typically see here in the US, because you do not have such a thing as a 30-year fixed rate mortgage. It's a market for U.S. companies, for sure, so you'll expect to see something of a headwind coming through as we start to see Q3 and Q4 earnings. What's been really surprising to us, though, and I don't think we're alone here, is just how little we've seen from China. I think everybody was expecting a very strong recovery as the Chinese economy exited the lockdowns. We expected a rebound from the consumer. We haven't seen that. And of course, we're all very familiar with the startling youth unemployment data up until the point when it ceased being published.
And so, Sinead, we can see the translation of these higher interest rates into the real economy through mortgage rates, et cetera, as you mentioned. Talk to us, though, about how these higher interest rates ripple through risk assets, and particularly what we see in the equity market.
Great point, Katie. And so what we're seeing today is really that repricing happening. So the 50 basis points that the market was expecting, that the Fed has now said they don't expect to cut next year, it's that repricing that we're seeing. Now, what we think is really surprising is that with fixed income yields at these levels, that more investors are not viewing this as an attractive level to add to their portfolio allocations. Compare this to where we were 2, 3, 4 years ago in terms of yields. These are incredibly attractive levels. Maybe there's a little bit higher to go in yields, but for the sake of a few basis points, you should be adding duration to your portfolio now.
Well, that's what I want to hone in on. Sure, maybe yields continue to go higher, but maybe not to the magnitude that we've seen them go higher over the past few months. What do you think is behind the hesitation to really forcefully step out the curve right now and lock in those higher yields?
This is something that we see in every period of volatility. You think about what institutional investors do when they rebalance their portfolios, right? If an asset class is down, they will add more. It's hard for investors in aggregate to do that. And so here are the 3 questions we get from our clients. The first is, what's going to happen with equities between now and the end of the year? And we're pretty constructive. We think the S&P will end the year close to 4,600. The second is, if I'm sitting in cash, having been enticed by some of those very high money market yields, when do I go back into risk assets? And then the third is private equity and venture capital. They've had a tremendous run over the last decade. Now interest rates are higher. Has the picture changed? Does that still make sense as an allocation?
Yeah.
And here's what's really interesting. If you miss in your portfolio even the 10 best days in the market, and we've seen this over the last 27 years, you reduce your annualized portfolio return by over 3%. I mean, that's a lot to give up. And so standing on the sidelines can be very, very damaging to investor returns.
All right, Sinead, we're going to have to leave it there. Great to catch up with you. Sinead Colton Grant, Head of Investor Solutions over at BNY Mellon. A lot more coverage coming up here, including the debate over financial regulation. A lot was going on in Washington this week. New rules by the SEC, a sit-down with Ken Bentsen, SIFMA's president and CEO, and why he says regulators are going too far.
Plus, almost 1 year after the collapse of FTX and the subsequent arrest of Sam Bankman-Fried, we'll discuss the state of the crypto industry with the former president of FTX US.
And we're going to get some insights out of Laurence Meyer. He's a former Fed governor and co-founder of Monetary Policy Analytics, one of the great minds in economics. His insights on the prospects for that soft landing, Katie, that you just put up that chart about. All that and more coming up in just a bit. Stick with us. This is Bloomberg.
All right, less than 45 minutes ago until the closing bells ring, and you're looking at a down market. If you're looking for some bright spots, though, you can find them behind me. You have United Health having pretty great day. So too is FedEx, almost up 4.7%. You can see the likes of some of these other healthcare companies, Comcast, CVS, and some others up as well. That's the good news, though, but obviously more stocks lower today than higher. Some of the big heavyweights all the way down there, Amazon, Nvidia, falling quite mightily today, bringing down the whole market, as too is Apple, off just 0.6%, but we're talking about a really big company there, really weighing on the S&P 500. And really, it's a sell-off across the board. If you look overall, you can see so too in the bond market. Surprisingly, you're seeing a little bit of love for the front end. That bid is sending 2-year yields down about 4 basis points. Then you go a little bit further out the curve, though, and you can see the sell-off continues. 10-year yields currently up about 7 basis points or so. And then you can see actually 30-year yields selling off the most, up about 10 basis points, just contributing to this sea of red. But it's time now for Options Insight. We want to get you up to speed on the day's options trading activity. We do that with Abigail Doolittle.
Well, Katie, you know, this sell-off that we're seeing here, it's not exactly out of thin air because we have been down since the late July, early August peak. We're now down about 6% on the S&P 500. Today, clipping right through the 100-day moving average, following what Apple had done a few weeks ago, of course, on yesterday's higher for longer hawkish pause Fed meeting. Chris Murphy, co-head of derivative strategy over at Susquehanna. Great to have you with us as always. And what am I missing? Because I think that the Fed, and in particular, Fed Chair Jay Powell, has been very clear, very consistent in terms of this idea of higher for longer, that they're not going to err on the side of cutting or backing off anytime soon. And yet, when that strategy is iterated in July and now in September, markets are a little bit surprised.
Yeah, I mean, I agree with you, Abigail. Maybe a little bit of wishful thinking on the side of some market participants. You know, we got maybe a little bit ahead of ourselves in July in a couple of the, techie kind of areas, but we're still not seeing a lot of panic in the options market. You know, more kind of an expected increase in volatility when you have the S&P and broad indices sell off like this. And, you know, I think, maybe Powell didn't say anything to really excite the speculative side of things, but I don't think that he wants to. So we're seeing a little bit of a moderate pullback here, but I don't think things are getting too out of hand on the volatility side.
Well, that's super helpful. And right now we do have the VIX at a 16 handle, almost a 17 handle. And if it does take out its last high, which is just a little bit further up, closer to, I think it's maybe like 19, 20 and somewhere there, it does suggest that there could be a bigger move higher. Are you seeing any confirmation of that elsewhere in the land of options? You're saying that you're not seeing panic, but are there any other little signals that suggest that things could continue to heat up? And let's remember, September is seasonally the worst month of the year.
Yeah, I think you kind of nailed it. Wake me up when we get to 20, and we'll start to get worried. We're seeing more volatility selling, particularly on the single stock level on days like this. It's just so consistent that, we don't even really necessarily get too excited every day. Investors are coming in and looking at selling puts. If I can think of just today, names like IBM and DraftKings and ADI and Apache. I mean, across the board, people are seeming like they're, more taking advantage of the increase in volatility than anything else.
From a macro standpoint, though, the VIX, we are seeing VIX calls buying the open interest on VIX calls pretty close to the highs that we've seen over the last 5 years. Puts on the decline. What does that say?
No, I agree with you. We're definitely seeing more action on the way upside VIX call options. But a lot of those are probably investors that are, big macro players that want to add exposure in general on the long side. And they're using these tail hedges as ways to, say that they're hedged and to be hedged in a way that they can then go add to their long exposure. So a lot of these trades aren't necessarily the sky is falling, panic. I think that the world's going to end kind of trades. They're more, let's put on a smart trade when the VIX is pretty low and the VVIX is low as well, so that then we can feel more comfortable about adding long exposure in other areas.
Got it. That's super helpful. A very helpful distinction in terms of that it's not outright bearish VIX or options buying, but more so a hedge. Great perspective, as always, Chris Murphy over at Susquehanna on this repricing of risk that we are seeing around the Federal Reserve. Thanks for joining us for Options Insight today. And from New York, this is Bloomberg.
Well, Romaine, it's looking like a dash for Dallas, if you will, from Wall Street for the banks. Bank of America moving its Dallas operations to a new skyscraper just a half-mile away from where Goldman Sachs is building its own hub. I wonder, maybe they're in walking distance of each other, it sounds like.
Yeah, maybe they can sort of reach through the window and touch hands there. I am curious about the move here. I mean, we know that Bank of America, obviously based out there in Charlotte, but they have a big presence there in Texas and in Dallas specifically here. I did spend a summer once in Dallas.
Really?
And it was hot, and that was before climate change. You just walk from the building to your car. So I guess, it's a decent place to live other than, June, July, and August.
Yeah, I've never been to Dallas. I would like to go, just haven't made it down. Maybe if Wall Street keeps moving down there.
Do you not like Texas? Do you not like barbecue? Do you not like what?
I think I would really like the whole vibe. I understand there's a lot of horses in Texas. That sounds appealing as well. But in addition to Bank of America and Goldman Armadillos, that's huge. Maybe that's why Wells Fargo is also there in a big way. They're actually also expanding their presence in the Dallas area, according to this story. They're going to have a new tower in the suburb of Irving. That'll accommodate more than 3,000 workers by 2025. Maybe you and I will be moved to Dallas. I don't know.
Did you just call it the suburb? Dallas is just one big suburb. One thing I learned about Dallas when I was there.
Yeah.
Yeah. Well, here's the thing. It's not really a city. Oh. They kind of make themselves out to be a city. It's just like this collection of all these suburbs that somebody decided to link by a highway and then call it Dallas. But it's like you learn very quickly here that if you want to get anywhere in Dallas, it's going to take you about 30 minutes on the highway just to go visit, the next neighborhood. So who knows? Maybe those two buildings are like 30 minutes apart. You just
That's true. That's true. In any case, you take a look at these markets right now. It's a pretty ugly day on the S&P 500 as yields continue to rise in the wake of that Fed decision. A lot more coverage coming up. This is Bloomberg.
This is the countdown to the close. About 30 minutes left to go here in the trading day, Katie.
And it's a pretty ugly one overall. The S&P 500 down by more than 1%. You take a look at the sector level, and it is all red. Every sector in the red right now. As you can see, utilities, the best of a bad bunch, down 0.8%. You can see some glimmers of hope when it comes to healthcare, but overall that sector down by 0.9%. You go down the list again to the very bottom. We have materials, we have consumer discretionary, and real estate, Romaine, off by a whopping 3.2% on this Thursday.
Yeah, and you know things are bad when you start to talk about technical levels. A lot of large cap companies today hitting new 52-week lows. Roblox, one of them, down 4% on the day, and now down about 40% from that reference price when it had the direct listing back in 2021. Amazon also having an awful day, down more than 4% here on the day here. 6th straight day of declines that we've seen for that stock. And remember, just last week, it hit a 52-week high, so a big reversal in sentiment. In fact, none of the Magnificent Seven doing anything of significance here on the day. If you're looking for a bright spot, though, FedEx, that's about it. There's only about 55 stocks in the S&P 500 that are higher on the day. FedEx among the strongest gainers here. That's on the back of a relatively encouraging turnaround story there when we got that earnings report. Broadcom also lower on the day, we should point out. And we were talking a little bit earlier about Darden. They had some interesting commentary about what people were doing in their restaurants. The idea that more people were coming into the restaurants, but they were maybe spending a little bit less. When you take a look at the open table data, this is basically the number of seated diners going into these restaurants here. That trend line, and that's the blue line that you're seeing there, kind of hard to see on the screen there, but that's actually been flat for several months now here. So that big spike that we had coming out of the pandemic where everybody was looking to go back out, Katie, that seems to have tapered off a little bit. And there is some concern when it comes to consumer spending that trend line might actually now start to move lower.
Well, let's go from the world of dining to the world of crypto, because Bitcoin still trading below $30,000 a year since the collapse of FTX. And of course, on October 3rd, Sam Bankman-Fried faces trial over his role in the company's demise. And the crypto industry, it's struggled in the months since, as the SEC weighs a spot Bitcoin ETF and investigates Binance's U.S. operation. Let's discuss the industry overall with Brett Harrison. He is the founder and CEO of Architect and the former president of FTX U.S., of course, leaving, I believe, in September of last year. And Brett, so talk to us a little bit about Architect. Of course, this is a software startup. It's a trading venture. You started it this year. How difficult has it been to spin up a new company involved in the crypto space, given the year that we've had?
For us, it's sort of been the perfect time to actually dig in and build a company while markets are quiet, volumes are down, and everyone in the industry has really been reconsidering what their role is going to be, who are going to be the players that are going to drive the industry forward. Obviously, we're seeing many of the traditional financial players look to launch spot ETFs. You see companies like EDX launching a new exchange. We have Cboe Digital entering the market, not just with their spot exchange, but with a futures exchange as well. And so now the traditional players are starting to come in while things are quiet. That's also a good time to be a technology provider to really assess what kinds of institutional infrastructure can really help that industry move forward.
So it's time to build.
It's absolutely time to build, as they say. So
in January, you raised $5 million. Are you trying to raise more money now?
Right now, we're really focusing on the build out of not just our institutional infrastructure product, but also we just announced just last week we received approval from the National Futures Association for a CFTC introducing broker license. So looking to build out regulated businesses in the exchange traded derivative spaces, not just for crypto derivatives, but for derivatives at large, in addition to the trading technology that we're working on. And that's going to be our main focus for the short term.
Hey, Brett, this is Romaine. I'm down in Washington today. And of course, earlier this week, we had a few new regulations come out by the SEC. And I know there's a lot of anticipation about additional regulations by the SEC, the CFTC as well here. I am curious as to how you're preparing for this idea here that umbrella of what they regulate and how they regulate it is going to get wider.
So obviously, with spot cryptocurrencies, there's not yet a clear idea of who is the markets regulator. Obviously, we have the SEC who deals with securities, and we have the CFTC that deals with commodity futures. But for something like a spot commodity like Bitcoin, there's not yet clear sets of rules for how the trading of those assets are regulated. And so from our perspective, what we're trying to do is sort of a twofold strategy. One, in the beginning, we're looking to just be the technology provider to allow people to have access to the markets, not just in the U.S., but outside the U.S., where there continues to be developments on the regulatory fronts in places like EU and Hong Kong. But in addition, we're looking to try to build regulatory structures within our company, starting with the CFTC, where they're introducing broker license, but eventually as well under SEC and FINRA as a broker-dealer, to be able to prepare ourselves not just to be able to provide traditional assets like securities, options, futures, different kinds of regulated products that trade on exchanges today, but also be able to prepare for a future where some combination of the SEC and the CFTC are actually regulating spot cryptocurrency trades, and you might need these kinds of licenses to be able to participate in those markets as a broker.
Do you think that some of the regulations, if and when we do get them here in the U.S., do you think they're going to be compatible or in sync, I guess, with what we might get out of Europe and Asia?
I think they're going to have to be. I imagine that the regulatory agencies in multiple jurisdictions, including the U.S., are in close contact to figure out how to make rules that really harmonize with each other. Obviously, you have a lot of cross-border activity. You have U.S. companies with non-U.S. entities and vice versa. There's so much cross-border flow from market makers, arbitrageurs, investors, that there almost has to be a global harmonized rule set, especially for something like blockchain technology, which in itself is inherently decentralized and participated in by participants all over the world.
And now that you got that introduction broker application approved, when you look into the future and you think about your ambitions, do you see a blueprint for who you're trying to become? Of course, you're starting in cryptocurrencies, but as you translate into more traditional assets, if you will, who should we think about who your potential peer set might be?
We're looking at the big existing brokerage houses and imagining, what would it look like to rebuild a lot of those structures today with modern technology, modern user interfaces, APIs, low latency programmatic access. One of the things that cryptocurrencies really brought to the market was incredible innovation on the exchange space, because these were exchanges that became cloud native from the very beginning. They were open access, free to access. You could onboard with them directly as a customer without going through intermediaries. And so that's why they really rose so meteorically from basically nothing and just being kind of an idea from tech startups almost. And so we are looking at how we can model ourselves off of a lot of those existing infrastructure choices that cryptocurrency derivatives exchanges have made to be able to bring a lot of those same innovations to the traditional asset markets in addition to the crypto markets.
And Brett, of course, we're having this conversation just weeks before Sam Bankman-Fried's trial begins over what happened with FTX. Of course, you were at FTX US, but we have to ask, has either side called you to either talk or be a witness?
No. I will be, following along some from home. Obviously, the whole affair is devastating, and what is most, of course, disappointing is the fact that after all of these months, it seems that Sam won't hold himself accountable for his actions the way that his colleagues have, and has really dragged this on to the bitter end. And it's very difficult, I think, not just for his colleagues, but for the entire industry to get any closure until this trial is over. So I think we are all in some way looking forward to a swift conclusion.
Well, we'll be following along closely as well. Brett Harrison, it's really great to see you. Really appreciate your time. Our thanks to Brett Harrison. Now, coming up on the close, software company Cisco is buying Splunk in a $28 billion deal as it pushes into artificial intelligence. We'll bring you the terms of the deal and what it means overall for the M&A landscape. This is Bloomberg.
All right, the IT landscape is changing, and today we're learning it's changing in a big way. It's our stock of the hour. A look at Cisco and Splunk. M&A activity there as Cisco agrees to buy Splunk, $157 a share. That's about a 30% premium to where the stock closed just yesterday. All told, it's going to wrap up to be about a $28 billion deal. Woo Jin Ho over at Bloomberg Intelligence joining us now to talk a little bit more about this deal. And we heard from the CFO a little bit earlier here, Scott Herren, who basically said that this is going to be cash flow positive once it closes in the first year. You buying that?
Yeah, look, it's going to be cash flow positive, right? Because Splunk was cash flow positive to begin with. You had a company that's generating roughly about $15 billion in free cash flow as it is. So this could take the combined free cash flow closer to $20 billion, even without synergies.
And tell us what exactly Cisco sees in a company such as Splunk.
Sure. There's a couple of things. First of all, Cisco's been on this multi-year journey of trying to have more software in their diet, especially recurring revenues, and Splunk actually fits that bill. There weren't many companies that were large enough to really make a meaningful move to the financial model. Splunk will actually raise their software base by about $4 billion or 8% of total revenue. That's one. And then two, it will help their gross margin profile and add roughly about $4 billion in recurring revenue on top of the existing $11 billion in product recurring revenue for Cisco. So you're getting a lot of recurring revenue for Cisco. Now, from a technology perspective, if you think about Cisco being the plumbing of networks, Splunk is the actual data microscope or the stethoscope of how everything works. So it actually works very, very hand in hand in Cisco's hardware infrastructure and Splunk software.
Yeah, there definitely seems to be synergistic. I hate that term, but that definitely appears to be one of the few deals where you can sort of see how it's compatible right from the start here. The next question, Woo Jen, is really simple here. Anytime you have a deal like this, everyone wants to know who's next. Is this something that's just specific to Cisco and Splunk, or do you anticipate additional M&A activity in the cybersecurity space?
Yeah, well, on the cybersecurity space, I think infrastructure software space in general, we've started to see some activity loosen up. We saw New Relic acquired, I believe, several quarters back by private equity, and from the downturn of the post-pandemic downturn where valuations were compressed, companies are really starting to have a better understanding where the balance sheets are going to be. So I wouldn't be surprised if we start seeing some active M&A going forward.
All right, Woo Jin Ho over there at Bloomberg Intelligence. A look at Cisco and Splunk. Splunk, one of the big gainers on the day, but that's all that's gaining. We should point out right now, broader markets hitting fresh session lows, down more than 1.5%. Sandip Bhagat joining us in a bit. This is The Close. This is the countdown to the close. I'm Romaine Bostick here in the political capital of the United States. Scarlett Fu joining me right now from the financial capital here on what is a really brutal day, Scarlett. One day removed from the Fed meeting, and the markets here in the U.S. and worldwide have clearly spoken here. A significant down day. In fact, right now, hitting fresh session lows for equities and fresh session highs for the benchmark 10-year yield.
Yeah, every time I look at the chart, it just takes another leg lower. And I guess this time investors are really feeling like the Fed meant it when they said higher for longer. They backed it up with their forecast. And as you mentioned, yields moving higher across the curve, except for the 2-year, but at 5.14%, it's not really much of a treat that we're seeing there. You guys talked about Cisco buying Splunk at a 31% premium to its last close. Perhaps some M&A could provide a little bit of a respite for the market here. We are, of course, keeping an eye on the recent issues, ARM and Klaviyo. ARM, of course, briefly trading below its IPO price of $51, still above it at the moment, but not by very much. All right, for more market analysis, we want to welcome now Sandip Bhagat. He is Whittier Trust CIO. Thank you so much for joining us on this day where we definitely see the risky assets taking a leg down. When it comes to the FOMC statement and the press release, the bond market clearly sees it as hawkish, as does the stock market. How much of their outlook do you think was influenced by the recent run-up in oil prices?
I would rather focus not on the movement in headline inflation driven by energy costs and oil prices, but the big positive piece of information from CPI reports were that core inflation actually fell significantly year over year. Energy prices are notoriously volatile, and therefore the emphasis on the core so that you can see through that volatility, I think very little. Chairman Powell came out and said it really wasn't so much a concern on inflation. It's the strength of the economy that has them spooked.
That's always the case, but there's always the concern that there's a follow-through or spillover from rising oil prices to everything else, particularly in services. So as you look at everything and as you construct your portfolio, I'm wondering whether you are constructing a portfolio based on a specific economic outcome here, soft landing or no landing, given what the Fed has projected, or can your positioning withstand a shallow recession?
In fact, it could. So let's quickly define these terms. We knew hard landing and soft landing. No landing is a new lexicon in this vocabulary.
It popped up in the last couple of weeks.
I know. So that hard landing is your conventional recession, -2% or lower growth for several quarters. By soft landing, I have in my mind growth approaching zero. You may end up a little bit above zero, a little bit below. A little bit below would be your short and shallow recession captured by the soft landing. The no landing would have growth only descend down to trend level, which for the US, I believe, is 2%. I have long held the view that the hard landing scenario is the least likely of these outcomes, even after yesterday. It's hard to imagine that we'll escape with a no landing and growth staying as high as 2%. So in that soft landing camp, where a short and shallow recession could happen.
Well, that's what I'm curious about, Sandip, is the market reaction really seemed to be predicated on this idea that if we are headed towards a soft landing, which they seem to be buying into, that could be at least a net negative given the way the market was positioned. But if we avoid recession, is there not some sort of value proposition in buying risk assets?
Absolutely. Look, we have seen significant disinflation, far more than many had expected, which brings us to this fork in the road. Should we celebrate this as a successful milestone in the journey to a soft landing, or should we still fret and wring our hands that inflation is still way above 2% and the economy is strong enough where continued strength will reignite inflation, send rates higher, and trigger a deeper recession down the line? I'm very clear. We have seen lower than expected inflation and stronger than expected growth. This pushes out the probability of that hard landing and the recession. That is good news, cause for celebration.
What do you think could maybe get the market excited, or at least get them to see basically what you just said, Sandip? If we're not going to get the rate cuts, which seems a lot of folks are disappointed about, do you think there are going to be certain parameters, whether it's economic data or corporate fundamentals, that will maybe reignite those sort of animal spirits?
Inflation continues to head lower. Let me share a couple of notes of optimism. Core inflation has some really stubborn and sticky components. Rents and wages are two examples. After a long, steady, and slow climb upwards, shelter costs have turned the corner. They'll likely descend for the next several quarters, next several months. Wage inflation has receded from 6% to just above 4% in the last year and a half. And the Fed itself projects that core PCE, by their metrics, will be as low as 2.6% at the end of next year. In that backdrop, it is so hard to see a Fed funds rate of 5.1%. I think incoming data on inflation and the economy will cause them to rethink. No mistake has been made yet. We are just all worked up. I think they will end up doing more rate cuts than they say they will.
So today's jobless claims print support the Fed's forecast of a tight labor market and better GDP, at least for this year. And of course, that drives the higher for longer narrative that's in place right now. How much weight would you attach to next week's data? We've got another revision of GDP and also, of course, the big jobs report. Does that matter to investors right now who are convinced of higher for longer, at least through November?
Not so much any one particular report in the next few weeks, but by the end of the year, we will see continued evidence of declining inflation. That'll be reassuring to the markets. GDP growth in the third quarter, we know, will be strong. Yeah. The question is what happens in the fourth quarter. Incoming data will continue to show a combination of growth that is not cratering and disinflation that is continuing its rapid compression and decline.
All right, Sandip, great to catch up with you. Sandip Bhagat there over at Whittier Trust, helping us count you down to the closing bells here on this Thursday afternoon. Just about 24 hours or so, Scarlett, removed from that big Fed meeting. And it's very clear here that there's a repricing going on right now.
Yeah, absolutely. You look at the WEI's function on the Bloomberg terminal, which tracks the world equity indexes around the world. It is a sea of red. And we're not just talking 0.5% low or anything like that. At least 1% declines across most of the major markets in Europe, in Asia, and certainly here in the U.S. as well.
Yeah. Well, 43.32, that is the low on the S&P 500, and that's basically where we're trading right now. In fact, a break below that 100-day moving average and most of the technical levels that had been kind of holding this market up and giving some optimism here to an upward trend line. That trend line now appears to be to the downside, at least for equity markets in this moment. We move closer to these closing bells on this Thursday afternoon. Our full market coverage right here on Bloomberg coming up next as we take you to the bell and beyond.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu. We're counting you down to the closing bell. You're here to help take us beyond the bell. It's a global simulcast with our friends Carol Masser and Tim Stenovic. Welcome to our audiences across Bloomberg Television, radio, and our partnership for those folks streaming on YouTube. Guys, you remember back in late August, we had that run on the S&P 500 back above 4,500, did not hold that. We had another run to 4,500 just over the past couple of weeks, and now that is not holding. Now flirting with 4,300 here on what is the worst day for the S&P 500 since the spring.
Don't you feel like all the technicians are out there and like rethinking these numbers and rethinking what the trend lines maybe that are being taken out today? Because you've got all major U.S. equity benchmarks breaking below their 100-day moving averages. It's seen as a bearish signal by some of the technical guys. So it is interesting when we break out these levels. Doesn't mean things can't turn around, but nonetheless, I do have a feeling that the technicians are kind of rethinking where we go from here.
I was just saying to Carol, guys, that it's been a week where we've just had a lot of bearish voices in our studio. You're just joined by Hillary Kramer, CIO at Kramer Capital Research. And she is so bearish, she thinks that we could see another 5 to 7% drop this year in the S&P 500, and even was talking about the Fed cutting rates this year if the market sees that. I pushed back on it, but she was pretty insistent.
Cutting rates later this year, even after they just came out and said that they're reducing the number of rate cuts for next year?
That's pretty much what Carol said.
All right. Well, you know, I'm glad we're thinking alike here. Totally. I look at the indexes and how they are below these key technical levels. Volume, it should be noted here, is higher than average, about 6% above, I should say, the daily average the last 5 days.
And remember, for all the changes, the upside changes that we've seen in price targets, a lot of those analysts and strategists have said that it is possible we could go back and test some of the year-to-date lows, and at least for today, we're starting to see that effect. The Dow Jones Industrial Average lower by about 1% on the day, down about 370 points, right around that 34,000 level, while the S&P 500 looks like it's going to finish the day right around 4,329, down about 72 points or 1.64 below that 100-day moving average. Similar story for the NASDAQ Composite, which is lower by about 1.8% on the day, and the Russell 2000 also lower by about 1.6%.
Yeah, Romaine, in a sign of the bearish sentiment and risk-off trade, look at the S&P 500, 465 names to the downside today, 37 to the upside, 1 unchanged. If you look at the NASDAQ 100, you've got 95 lower, Scarlet 6 higher for the day. So really investors not really wanting to even think about being even a bit bullish, it feels like, in today's trade.
Yeah, well, look at the...
Can I just say, too, this was one of those days where you had basically 90% of the S&P in the red, and that's something that is, at least as of late, has been relatively rare.
Absolutely.
And that shows up in the industry sector performances, too. This is the S&P 500's 24 industry groups. You can see everything is down. In fact, there are at least 8 groups that are down by more than 2%. So that's notable here. Real estate, investment trusts, retailers, and consumer durables and apparel, that's the home builders, all down by 2.75% at least. The better performers, healthcare equipment, transportation, and household and personal products, your defensive sectors.
All right, a lot of red there. So it was a little tough to find some green, but I got an assist from my co-pilot here, Tim. FedEx, obviously, we broke down their earnings after the close yesterday, finishing way off its highs. Guys, it was up about 7% at its best levels of the day today, but finishing still with about a 4.5% gain. Top in the S&P 500 today. Profit topped analyst estimates, an increase to the low end of its earnings forecast. And I got to say, the analysts were out in full force. Evercore, Wells Fargo, Raymond James, B of A, Morgan Stanley, among those that raised their price targets on the company. Very positive on the company's progress in terms of cutting costs and also highlighting the strong performance at its ground unit. So the guidance is still conservative. So maybe looking for some more upside there in terms of the company's performance. Fox, big story. I know you guys are talking about, we are too, certainly a big media deal. Earlier this morning, 92-year-old Rupert Murdoch saying he is going to step down as chairman of the boards of both Fox Corp and News Corp following a nearly 7-decade career. He's going to become chairman emeritus, his son Lachlan taking over as chairman of those companies. Fox up about 3% and top performing the S&P 500. How to do Splunk? It is obviously the target for Cisco, the takeout. Cisco buying Splunk for $28 billion, an AI play in a big way for Cisco, but also giving it more security for everything that runs on Cisco's infrastructure systems. Splunk, by the way, up about 21% in today's trade. But again, makes sense. It was the target. It was the takeout.
Okay, well, let's look at Cisco, the company paying $28 billion for Splunk, finishing the day down by more than 3.7%. 3.9% is the decline that we're seeing there. I asked Woo Jin Ho, our Bloomberg Intelligence senior tech analyst, Romaine, why the stock was lower, apart from, everything else being lower today. And he said that he was actually quite comfortable with the deal size. Oftentimes, though, we do see the company that making the big acquisition move lower on the day. He did say that on the call today, announcing this acquisition, some analysts were still looking for a company that has faster growth software company and more modern network architecture. The deal that moves the needle, right? Oh, yeah, biggest deal in the company's history. Let's look at Amazon. It's the worst performer on a points basis in the S&P 500, leading a decline in mega cap stocks, down more than 4.4% today. Closed down for its 6th straight session, longest losing streak since February. The stock losing more than 10% over that 6-day period. And then TKO Group Holdings. This is the company that owns World Wrestling Entertainment, UFC as well. Finishing the day down, close to 18%. Came after a new deal to broadcast its matches on the USA Network, disappointed some investors. Geetha Raghunathan saying that the new deal is estimated to be 40% higher versus the prior deal that was on Fox, slightly lower than the 50 to 70% hike seen in recent renewals. So a little disappointing that the company didn't get more money for these media rights.
Yeah, a lot of stocks down here on the day, a broad-based sell-off. The VIX elevated around 17, a sell-off in the commodities space, and a sell-off once again in treasuries, this time mainly in the belly and in the long end of the curve. You take a look at that 10-year yield right now at 4.48 and change right now, up about 8 basis points. We're higher by about 12 basis points on the 30-year yield. Now, you did see a little bit of a downdraft in 2-year yields, ever so slightly, down by about 3 basis points, excuse me. But I thought it was interesting, too. We had the latest MLive Pulse survey that was conducted immediately after the Fed's decision yesterday here. And in that survey, most of the participants, the majority of them, said 2-year yields have yet to peak.
So where do we go raises the question, exactly. What's the next level?
Yeah, I mean, really, what are we at? 514 right now. So how much further can we go? We were up near, almost 5.2 on it. So I don't know. What is the top point? And then what does it mean in terms of the Fed trying to get inflation lower? Do they need to kind of rethink, once again, that target that many say that 2% is not realistic?
They've been so clear that they are not going to rethink that target at all. I think it points to the fact that, rates are going to have to be higher for longer if inflation doesn't come down to that 2% target, Romaine.
But it's a totally different conversation to say rates are going to be where they are higher for longer. It's another conversation if you actually believe that we haven't actually hit that peak yet. So you mentioned 514 on a 2-year yield. I remember there were people last week talking about that 6% was not unrealistic. And I kind of guffawed, I think, the first time I heard that. But now maybe I'm starting to become a believer in that as well. And then that gets back to what you were just talking about, Carol. You pull out your Excel spreadsheet or your TI calculator or whatever you're using to do your financial model. I know you don't do anything, Carol, but for those folks that do that, it changes the calculus.
No, it does. It's a major rethink in kind of how we do everything. We're going to talk with a bank CEO, regional bank CEO, and I'm just curious about whether he thinks that this is, kind of a rethink in terms of the lending environment, the costs of capital. I keep thinking about the costs for companies and their debt loads, ultimately, if they have to refinance and so on and so forth. I mean, this changes the dynamics. It changes the equation. It changes the spreadsheet, if you will. It's a different environment.
And the cost for consumers as well. We've already seen mortgage rates top more than 7%. I mean, it gets ever more elevated in a market where there's actually no transactions because no one wants to give up their almost zero rate mortgages that they've locked in before the pandemic. So that combined with the resumption of student loan payments and other expectations that perhaps at some point the job market will soften or anxiety will rise is going to mean curtailment on consumer spending.
I mean, yeah, if we're on the topic of regional banks, are you actually going to keep your money in that bank if you can get a 5.5%, Romaine, in a money market fund or at the short end of the yield curve?
Yeah, I am curious, guys. I mean, kind of what comes next here? Because the market was so focused on what the Fed was doing or not doing, and we've kind of seen, I guess, the end result of that. And, I mean, is it earnings? I mean, is that going to save this market, or are we kind of just listless for the rest of the year?
I think it's government shutdown. I think it's UAW strike. I think it's those things that are outside of the Fed's control.
I think it's earnings. I think earnings always helps us give us some clarity. If CEOs say, yeah, folks, we got it. But you know what? Look, Cisco did a deal. They felt confident to do it. We had IPOs this week. Like, there are still companies making decisions and doing things. And I think that's a really...
We had IPOs
but does this shut the door?
Three of those IPOs, Three of those IPOs have already broken the price. I mean, to the downside. I mean, what does that tell you? I mean, yeah, I mean, it's good that they came in the market, but there's no enthusiasm in the secondary market right now for these.
Yeah, it might shut the door for further IPOs. All those Birkenstock, who knows whether they'll go public.
You want to go to Ruth Chris Steakhouse and get a cheap wine? What do you say?
Or a trip to Europe.
If you're buying.
What about a trip to Europe?
As long as you bring your credit card, Romaine, I'm in. I'm in. All right, guys, that's a wrap. Our cross-platform coverage. Talking about the markets on this Thursday. It's confusing, it's complicated, and certainly more to come. Our cross-platform, radio, TV, YouTube, and of course, Bloomberg Originals. We'll all catch you tomorrow.
All right, stick with us. We got a lot more to cover here on Bloomberg Television. A conversation with Laurence Meyer, former Fed governor, going to be joining us in just a bit to give us his take here on economic conditions and the pace of where the Fed goes next. This is Bloomberg.
The prospects for a soft landing are very good, but you haven't landed until you get inflation back to 2%. So you're only partway through this process, but prospects are looking good.
When people say, well, we're going to have a soft landing, I'm skeptical. I see a world where financial conditions have gotten tighter, and it's just a question of how long that transition mechanism, which will probably be longer than it's taken in the past.
Just heard there from James Zelter speaking a little bit earlier, as well as former St. Louis Fed President Jim Bullard, who had to sit down with our very own Michael McKee. Of course, everybody right now talking about the big rate decision yesterday by the Federal Reserve, a rate decision, of course, that was no decision at all. But we did get a little insight here into the Fed's thinking about the path of the economy here. Major revisions in its economic projections that, at least for right now, seems to have vexed the market. Joining us now to talk a little bit more about what we learned yesterday and what the path forward could be is former Fed Governor Laurence Meyer. He's now the co-founder of Monetary Policy Analytics, and he joins us here in our Washington, D.C. bureau. Great to have you here, Dr. Meyer.
Good to be here in the studio.
Absolutely. So much talk about the Fed statement, so much talk about Jerome Powell's press conference, but it was really those economic projections, the summary of economic projections, that really seemed to take the market off guard. Yet when I looked at those projections, I didn't necessarily see a bad economy.
Oh, my God. You get to macroeconomic heaven in 2026. What could you want? Perfect. And that was easy to project. Because when you're out that far, they're always going to think, if they carry out appropriate policy, they'll get where they want. They want to be at the minimum sustainable unemployment rate. They want to be at their inflation objective, growing a trend. My goodness, not surprisingly. And what's interesting about the forecast is the chairman has generally said that we need a period of below-trend growth to raise the unemployment rate enough, to create enough slack to bring inflation down. Now, I don't think that's the case. And obviously, neither do FOMC participants.
There's been a lot of talk, though, about where we are with regards to the labor market. You still have an unemployment rate that's sub 4%, I think. And if you look at the economic projections, not really projected to go much higher than that right now here. I feel like the economic wisdom, the conventional economic wisdom of the past was that you can't really have a meaningful fight against inflation without having a meaningful uptick in the unemployment rate.
Absolutely. That is the conventional wisdom. And most of the time, that's right. This is an absolutely unique period, nothing we've ever seen before. So I would tell this story this way. We don't need below-trend growth. We don't need a meaningful increase in the unemployment rate. Why did inflation rise above 2%? Supply constraints.
Okay.
Why is it falling today? Supply constraints. How we get to 2%? Just, easing of supply constraints. So I say the Fed gets no blame for the increase in inflation and really no credit
Yeah.
for getting back to 2%. It happened on their watch because of these shocks.
There was a great paper that came out of Jackson Hole and a separate paper that also talked about the supply side dynamics and the idea that a good portion of the disinflation that we've gotten really has less to do with Fed policy and much more to do with some of those supply side issues writing themselves here. Why don't you hear Jay Powell and other members of the Fed speaking about that more?
Well, that's an interesting story, and I'm perplexed a little bit. I think this has become conventional wisdom. I think it's conventional wisdom inside the committee. It's implicit in their forecast, but not the narrative. The narrative hasn't caught up with where the forecast has been for a long time. So I expect in future press conferences he'll be a little clearer.
I'm glad you characterize it like that, because we have the policy itself, which of course has market implications, and of course the narrative, communication, which also has major implications. And usually those two things are relatively in sync. There seemed to be a little bit of, if you had a chart of those two things, I think those lines would kind of be going in opposite directions.
Yeah, a little bit. Yeah. I think particularly Powell's narrative, less so for the committee's narrative and not at all for the SEP macro projections. So for a while, this was a very unique perspective, controversial, that was all supply and not demand. Now the opinion has converged to that, which is very good for the Fed. They'll get credit for it. That's fine. Yeah. When things go bad, you get blame. Okay, it goes both ways. But that's the reality why, in this case, uniquely, you don't need higher rates to bring down inflation.
Do you think the Fed understands that, even if they don't want to articulate that?
Oh, clearly they do.
Yeah.
That's what they show.
Right. When you look at the rate decisions that we've had, I mean, just starting through this rate hiking cycle, the fact that all but two of those decisions were unanimous, including yesterday's decision here, does that, I guess, A, does that matter? And B, do you think that unanimity starts to break down now that we're sort of in a more difficult part of this cycle?
So the chairman's rate decision is never questioned, and it's his job to build as much consensus. Now, when you're kind of at turning points, it's even more important that everybody speaks with one voice, and they tend to do that. So it's to the chairman's credit that he's been able to build enough consensus that there are no dissents. Now, the committee is still a little bit split, but the people say, I would have preferred this, but I can do what you want. Okay, that's where they are.
I'm curious then, draw a comparison between how you sort of rate Powell and your time when you were at the Fed, and of course, it was a much different dynamic. The same general concept, right? Get everybody in line, make sure that at least publicly we're all on the same page. But they were two completely different men in the way that they did that.
Right. Well, I think that's right. I mean, Greenspan could impose his will much more directly. And he was a great person and totally sort of respected, as Powell is. So there were always, some people had a propensity to dissent. Okay, and they were there. For governors, it was very unusual to dissent. I can remember, I think, once that a governor dissented while I was there. That's a bigger deal because you're sitting with the chairman. Yeah. You're part of the team. But today, people are so much more explicit and transparent about their views that it locks them in to a certain sort of position. So it's good. I think the consensus is probably going to continue, maybe get a little less, more of a problem when you get to the timing of easing and the pace. That's the next time we'll see the debate get more contentious.
If you were still in that room over the next few weeks and months, as the Fed really does have to confront that decision, would you advocate for just keeping rates where they are right now?
Well, 5.4, 5.6. Who cares, really, as the chairman said, makes no difference in the forecast. I think I'd support one more rate hike, knowing that that's the peak. I'm more comfortable there. Get it over with. Take out that uncertainty from the markets and say, okay, now you tell us on a long hold. Well, we don't entirely believe that, but there's much less uncertainty.
Jay Powell was asked a lot about other sort of economic forces that are probably somewhat outside the purview of monetary policy. The labor strikes that we've been having, the potential for a government shutdown. As he obviously would, he sort of dodged those questions. But I'm curious, does he need to start to take those things into greater consideration?
Well, it's a very good question. You know, we call those risk factors. We don't exactly know what would happen if these things happen. So we try to say, I'm not putting that in the forecast. Mm-hmm. Now, they said the staff didn't run alternative scenarios. That I'm surprised at. Mm-hmm. But we don't know if there's a larger and more prolonged strike, exactly what it would do, how long it would take, how big the snapback would be. Mm-hmm. And a government shutdown, you know, we know what that would do, but we don't know how long it will be. And that's relevant, you know. Is the Fed going to raise rates in the middle of a government shutdown? Not a chance.
Yeah. Not a chance, and we forget that even if there's a government shutdown, they still have to do their job. They're still funded. All right, great to have you here, Dr. Meyer. A great conversation here with Dr. Laurence Meyer. He's a former Fed governor and the co-founder of Monetary Policy Analytics and advisor to all things going on there in the macroeconomic landscape. Stick with us. Conversation coming up here about what's been going on in Ukraine. The U.S. continues to be the largest military backer aiding Ukraine in the war against Russia. $45 billion committed so far, but some concerns here about while any more money would be committed. That conversation coming up after the break. This is Bloomberg. The Ukrainian President Volodymyr Zelensky in Washington today, meeting with the President of the United States at the White House. Bloomberg's Kayleigh Lyons joins us right now to talk a little bit more about the context for this visit. Context, Kayleigh, that I think revolves around whether we're going to give them more money as they continue to fight off Russia in that war.
Yeah, that's absolutely right, Romaine. Of course, he didn't just go to the White House today to meet with the president. He also spoke with members of both chambers of Congress. First, the House of Representatives, in which there is a certain section of the Republican Party who would no longer like to give Ukraine any funding. There's real concern about accountability, just thoughts that the money should not continue to flow there if they aren't making real progress in their offensive at the moment. In the Senate, the reception probably was a little bit warmer. Mitch McConnell, the Republican leader in the Senate, has been very adamant that the U.S. should continue to support Ukraine. And Zelensky was there meeting with all of the senators. It was just a small group in the House. But there really is discord around this in Congress, even as the Biden administration continues to push for more funding. They've asked for $24 billion in a supplemental. But with the funding fight that's going down on the Hill right now, it is very unclear at this time if that will actually pass and in what form.
Well, let's talk about that funding fight. One of the main reasons why I came down to Washington was to try to make sure that we keep the government open here.
Good luck.
They did not take my advice. But I am curious. I mean, it seemed like just a couple of days ago we heard from the Speaker of the House, Kevin McCarthy. He seemed, at least publicly, to be pretty optimistic that a deal would get done and we would avert the shutdown at the end of this month. But based on the reporting that we're seeing today, it doesn't seem like there are too many members on board with him.
There are members on board. The question is there enough members on board? Because he can only afford to lose 4 votes. And it seems that there are more members than that who are not for what his solution was, which is a continuing resolution, basically just temporarily fund the government for a period of time. He would like to fund it to October 31st. The problem is there's a number of members of Congress who don't like continuing resolutions. They just want to pass the spending bills. One of them is Republican Congressman Matt Gaetz, who has also threatened to oust the Speaker through a motion to vacate. I caught up with him outside the Capitol earlier. I think we can play a little bit of what he said.
There will not be sufficient Republican votes for a continuing resolution. Now, if we've got some of these moderate Republicans who want to go and join up with the Democrats, they will be signing their own political death warrant.
And he's kind of spelling out there, Romaine, the catch-22 for Speaker McCarthy. On the one hand, you want to keep the Speaker's gavel. That may be difficult if ultimately what this comes down to is you have to make a deal with Democrats in order to actually get the government funding because you can't get enough members of the Republican Party in line. It's a very difficult line for him to walk. And to this point, it doesn't seem like he's been very successful. Lawmakers in the House are heading home today and not coming back till Tuesday.
Not coming back till Tuesday, so they're out of the picture. What is the Senate doing in the meantime? Do they have no choice but just wait until the House sends them something to work on?
Theoretically, yes, Scarlett, they would receive a continuing resolution from the House and then could edit it and send it back. And if some of the things that more of these hardline Republicans want in it, the fact that it could not have Ukraine funding, could include more border measures, could include more extreme spending cuts, it is very unlikely that the Senate's going to go for that. They would probably edit it and turn it back to the House, at which point the government may shut down because House lawmakers aren't going to want to deal with that. The Senate, to this point, has had more success in actually passing appropriations bills. Some of them, a minibus, have hit a little bit of a roadblock in that process. But by and large, there is much more bipartisanship in the United States Senate at the moment than there is in the House, where you have the likes, as we just heard Congressman Matt Gaetz saying that Republicans and Democrats shouldn't necessarily be working together on this.
So we've been on the cusp of a government shutdown so many times in recent years, but I wonder, given that the government runs out of funding next Saturday and October 1st, Sunday, it officially doesn't have the funding for the new fiscal year, are there preparations being made in any way? Is there a sense of perhaps panic, or is it kind of business as usual right now?
I wouldn't say we're at panic point yet. Usually that happens right before the clock strikes midnight here in Washington, Scarlett. And of course, we have seen this happen before. There have been a number of shutdowns just in recent years. What may make this one different is that this is coming at the same time that also at the beginning of October, student loan payments are going to start having to be made again. There is the ongoing UAW strike. Obviously, we're in a very different rate environment than we have been in shutdowns past. All of these other things that could create drags on the economy that aren't necessarily there in any other government shutdown we have seen. All that said, this does not feel like it has the panic that the debt ceiling fight had. No one wanted it to fall because of potentially catastrophic ramifications. No one really feels that way necessarily about a shutdown.
I have no idea, Kayleigh, how you live and work in this town here with all the madness going on. If you want to hear more of Kayleigh Lyons, be sure to stick around here, 5 p.m. Washington time. You'll see her on Balance of Power, all things political here. We're going to continue our conversation about what's going on in Washington with the state of financial regulation. Ken Bentsen, the SIFMA president and CEO, he's on deck.
I'm Scarlett Fu. Let's take a look at how markets performed on the day. A sell-off sparked by the Federal Reserve's higher for longer mantra, despite not moving on interest rates yesterday, circled the globe and made its way back to the U.S. You see a lot of red on the screen there, with both equities and treasuries moving down. So yields go up, certainly on the 10-year and 30-year. On the 2-year, actually, we saw a little bit of a pullback in yields, down to 5.14%. But that is still fairly elevated, holding near the highest level since 2006. What we did see gains in, the VIX. The VIX moving up to just over 17, and the dollar moving marginally higher as well, Romaine.
All right, Scarlett, here in Washington, D.C., a focus on financial regulation, because yesterday the Securities and Exchange Commission voted to impose the most sweeping overhaul of so-called fund labeling regulations, the most sweeping overhaul we've had in about 2 decades. And let me tell you, this isn't going to be the first that we're going to get from them. According to SIFMA, which represents the securities industry, the SEC under Gary Gensler is on track to finalize 63 new rules by the end of his first 4 years in office. The organization argues that that might be a little bit too much, too fast. Ken Bentsen joining us right now. He's the president and CEO of SIFMA, which, of course, represents broker-dealers, investment banks, and asset managers. And let's talk a little bit about some of these rules. I know some we have, some we haven't gotten yet, but I think we have a pretty good lay of the land, I think, of what Gensler wants for this industry here. How much pushback do you think has happened so far, and how much more pushback do you think there might be to some of these rules?
Well, first of all, thank you for having me on the show. Always great to be with you. What we're concerned about is rules that are being done where there's not a market failure. So you think about things like the proposal around restructuring our equity market structure. We have the most efficient equity markets in the United States. We don't see where there's a market failure that you want to go up in that market. We see retail investors have never had the ability to enter the market and get the pricing that they get in the equity markets and the liquidity that we have compared to other jurisdictions around the world. So we worry about things like that. We worry about trying to reform the markets. This isn't post-Dodd-Frank where there was a clear mandate. This is really the SEC kind of out on its own looking for issues that really don't have a problem.
Well, that's what I'm curious about. I mean, what do you think he is trying to accomplish here? I mean, Dodd-Frank was born, whether we're right or wrong, it was born out of a necessity to address, what happened during the global financial crisis. I know Gary Gensler might argue that there have been some events over the past few years that he feels regulations need to address. But what do you think is the motive?
Well, I think that there's a desire to, in some cases we don't know, but I think there's a desire to say, well, maybe we should try and make things even better than they are. But you really have to be careful in doing that. You don't want to upend our markets. By the way, I would add to that, not just the SEC, but the Federal Reserve as well. You just had Larry Myers on, outstanding former member of the Fed. The Federal Reserve's come out with a capital rule that would raise capital on trading activities of the largest institutions by 60%, with really no justification for that. Would raise capital on wealth management business, which is the fastest growing part of the securities business, with no justification for that. So what we have really is not the SEC with a voluminous rule book proposal that they're putting out, in some cases without any clear justification or evidence of a market failure. And then we have the Fed coming in with the capital rules that will really put, it's not just about banks, but it's about the dealing activity of banks and the dealing activity of the large market share that's going to raise capital. And this is happening at the same time. Again, Larry's just talking about where interest rates are going to go, and we have increasing issuance of treasuries. So if we have higher interest rates, higher costs to issuers, and at the same time we're going to raise the cost of capital among dealers, you're just going to push the cost of raising capital to the issuer community, whether it's corporates or state and local governments, by compounding all these things. And for what reason? So we think policymakers from the SEC, and as well as the Fed, need to really step back and say, what are we really trying to accomplish here?
So, Ken, isn't there an argument to be made that regulators like the SEC want to get ahead of potential market failures rather than waiting for something to blow up and then responding after the fact?
Well, I'm sure people would like to make that example, but there you're trying to predict the future. And, while we've had certain issues that have come up over the last 10 years, on the whole, our markets have operated extremely efficiently and effectively over the last 10 years since the great financial crisis. And even if people go back and say, oh, well, look at March 2020. March 2020, the government effectively put the economy into a coma because of a public health issue. For all the right reasons, and create a confidence issue. But the markets came out of that very, very strongly. So I think you don't want to fix what's not broken. And that's our concern here, particularly, and again, in a time of rising interest rates that appear that will be with us for some time to come.
One thing that some bank executives have talked about is all these regulations, especially the increased capital rules, will just be a great thing for the non-bank lenders, for that part of the industry. Gary Gensler has been extending his reach to hedge funds, to private equity firms. What's your organization's take on this increased level of scrutiny of these non-bank lenders? Is it justified? Do you think there's a need for it?
Well, SIFMA represents the broad securities market. So we have both bank dealers, non-bank dealers, asset managers, and again, in the most efficient market system in the world, the ones that the Europeans want, that the Asians want, for good reason. What our concern with the capital rules in particular is that you're going to really squeeze the ability for bank dealers to allocate capital to products like securitization, treasury underwriting, corporate debt, and equity underwriting. And the large institutions already have such volume in that they're either going to have to pass on the costs to their issuers, or they're going to have to pull back from those markets because they'll be inefficient for them to do it. So really the situation is you're going to be taking capacity out of the market that is going to have a knock-on effect to the issuer community and to the investor community.
I am curious, Ken. I want to get your thoughts on one specific proposal. This is on the hard close and how that is going to potentially affect broker dealers, and more importantly, I guess, for those folks that are trying to either close out or start new positions in some of these mutual funds.
Well, so this isn't the case in trying to deal with particularly bond funds, but in mutual funds. The hard close, and the reason you would have to have a hard close is this proposal to put in swing pricing for funds is a concept to basically deal with what's perceived as first mover advantage when you have market adjustments. The problem with that is if you do a hard close, you're first of all geographically discriminated against the further west you get. Because there's no way that you can actually comply with it. Yeah. So this is where you've seen many members of Congress and others weigh in and say, well, wait a minute, particularly from the West Coast. They said, wait a minute, why is this going to why are you going to disadvantage my retail investors? And this is particularly true in the retirement space. So this is a situation where I think perhaps well-intentioned, but I think as the SEC is hearing about this, I think they're going to have to really rethink what they're doing because they're really going to penalize investors, retail investors, at the end of the day.
One of the criticisms of that proposal, as well as some of the other proposals that we've heard from, is this idea that there is an intent to minimize, to some degree, the role of intermediaries. The idea that if you can sort of reduce the role of middlemen, that in theory, and again, this is just playing devil's advocate here, you create more efficiencies.
Well, First of all, again, it'd be hard to find a market system, a securities market system that's more efficient than what we have in the U.S. today. We would challenge anybody to do that. Second of all, our markets and our economy are so efficient that we see disintermediation occur all the time. I don't think that disintermediation by government remit or government mandate is a right idea. I think we should let the markets operate within the rule set that we have with fair and efficient, transparent markets. But the government shouldn't be in a role of picking winners and losers, or it should let the markets evolve. And they've evolved pretty well in the United States.
You know, Romaine started us by noting that the SEC under Gary Gensler is on track to finalize or propose 63 new rules by the end of his first 4 years in office. That is almost as many as his two predecessors combined. I know that's a data point from SIFMA. One thing that's noteworthy, though, is unlike Jay Clayton or Michael Piwar, Gary Gensler comes from Wall Street, right? He was heading up fixed income and Asia operations at Goldman Sachs for years. He's not a lawyer or an economist. I'm curious, isn't having one of your own, someone formerly from Wall Street, a good thing for your members?
Well, it's always good to have someone who understands the business. And to be fair to Jay Clayton, he was a deal lawyer at Sullivan and Cromwell before he became SEC chair. So I think he clearly understood markets. And before him, you had Mary Jo White, who had been involved in more on the enforcement on that side. So maybe not as much a markets person. So I definitely always welcome having someone who understands the markets in the business, in the regulatory side. But that doesn't necessarily mean that all the ideas that the SEC are putting out are good ideas. So I've known Gary for 25 years. I worked with him when he was at the Treasury, and I was in the Congress. We both came out of the business. But it's one thing to understand how it works. It's another thing to put forth ideas that are solving a real problem that exists. And we have some disagreements where we think in some cases there are not market failures that require the SEC to act. And one thing to say, if you look at equity market structure, one point about that is Congress, if you go to the meme stock situation, Congress held numerous hearings. The House Financial Services Committee, under a Democratic majority, put out a report with about a dozen recommendations in there. In those recommendations, none of those there were no recommendations to restructure our equity markets as the SEC has proposed. So what the SEC should do is what they propose, known as 605, is gather more data, update the way they collect data on equity market transactions, and then decide whether there's a market failure, because we certainly don't see that now. And most academics and economists who have commented on that proposal don't see it either.
All right, Ken, great conversation. Going to have to leave it there. Right. Ken Bentsen, he's the president and CEO of SIFMA, representing a good portion of the financial industry. A great conversation here about financial regulation. When we come back, another conversation about central banks. This time, it's Bank of Japan's turn. Their announcement scheduled overnight. Erin Murphy, deputy director and senior fellow at the Center for Strategic and International Studies, is going to be joining the big program. Stick with us. This is Bloomberg. It's been a busy week for central banks, and investors are awaiting yet another announcement, this time from the Bank of Japan, scheduled to happen overnight tonight. The BOJ widely expected to keep its monetary stimulus unchanged, even as the yen trades near a 10-month low. Enda Curran joining us right now, who helps lead our coverage here at Bloomberg on this topic. And Enda, I know we're not expected to get any sort of meaningful change in policy itself, but you have a market that's still kind of sitting on edge, wanting to hear something out of them, whether it's about yield curve control, whether it's about defending the yen. Are we going to get any of that?
Oh, yeah. I mean, nothing on the policy front, but two things to look out for. Number one, will Governor Ueda add any more to this idea that maybe they might move out of negative rates at some point in the near-term future? They're the last developed economy central bank in the world to have negative rates. So will he give any hint towards that? He gave a newspaper interview a few weeks ago, stirred a lot of excitement that maybe Japan is moving towards a rate hike. That's a big deal, number one. Number two is, will he comment on the currency? It's at a 10-month low, like you mentioned. Japan started to buy its own currency a year ago for the first time in over 20 years. So an intervention by them would be a big deal. So we'll see if he jawbones up the currency. But as I say, with the Bank of Japan, even though there's nothing expected on the policy front, any kind of tweak from them is a big deal for global markets, given the amount of Japanese capital that has gone overseas. Any hint of higher rates at home, that money would go screaming back to Japan.
Okay, so this might be a meeting in which he drops some breadcrumbs for investors and for market watchers to kind of chew on. The Fed was hawkish yesterday, as you know, and we saw what happened to risky assets and to treasuries for that matter. A lot of red across the screen. What kind of influence does that have on Governor Ueda?
It has to have an influence. I mean, the Fed definitely influences all central banks, as you know, Scarlett. But take Japan for the moment. They're struggling with the yen at a 10-month low. The officials came out last week, I think it was, and made a warning that they will be willing to take some steps if they see kind of further volatility. That's code for they could intervene, and it's code that speak for against the strength of the dollar, which is really causing them a lot of problems. So I think the Fed will be part of the mix there. But, you know, the Bank of Japan has been an outlier for so long now. They're not going to respond just to what the Fed is doing. There are some domestic conditions at home. They've been kind of looking through the inflation story. They've been saying it's mostly tradable, mostly imported. They haven't been a buyer that it's going to be a long-term inflation spike in Japan. So, but any hint of a change of tone in that now, that they feel that they do need to start tightening because of inflation, I think that would be really interesting.
We've been talking so much today, and here about the very severe market reaction to the Fed's policy decision yesterday here. Are you anticipating that we're going to see a lot of market volatility around the BOJ decision?
If they send a tweak on the negative rate, absolutely. Right. Likewise, if they send a kind of a hawkish signal on the yen, you would see some reaction there. But any hint of a change in the BOJ typically sends major eruptions through global markets. I've seen that time and again. And by the way, they've been known for surprising the markets in times past. So I would say, especially in the negative rate, if Japan hints are moving towards a rate hike, that's a big deal.
And Curran there, here a look ahead to the Bank of Japan decision scheduled to happen overnight U.S. time. We're going to continue this conversation right now with Erin Murphy, Deputy Director and Senior Fellow at the Center for Strategic and International Studies. And Erin, there was so much talk over the last few years about, I guess, kind of the Japanification of all these economies. And I guess to a certain extent, we saw some of that when we had negative rates in Europe and to a certain extent here in the U.S. But is it now kind of the flip side of that? Is Japan's turn to try to converge with the rest of the world?
Well, it seems that Japan always looks to buck the trend and go its own way. I mean, I think there was a big concern about the Japanification of the EU in U.S. markets, especially when you look at the 90s and its years of deflationary policies and just the last decade, if not decades. And certainly no country wanted to stay in that position. It took Japan a long time to get out of that. But Japan, you know, I think it's surprised many or not for folks that do watch Japanese news, especially its monetary policy, that it will probably continue to go this way, but recognizes at some point something has to be done with its interest rates. But it's really stuck in a much different position than the U.S. and the EU are in terms of inflationary pressures. They're likely to continue this course.
What do you make of Ueda so far? I know he's still relatively new, at least in this current job. But when you look at some of the comments that he's made publicly and just the choice of rhetoric here, how does that sort of stack up for you?
Well, I think he is a little less shock and awe than his predecessor. But I think what he's trying to do is to control an economy that's in a fairly fragile state. Again, Japan's inflationary pressures are much different than the U.S. in the EU. They're facing an aging population, stagnant wages. The strong dollar, as Enda said, is really what's driving this issue. And any wrong move could really hurt the economy. They're thinking of global markets, but more directly thinking of the domestic policies. I think he's trying to maintain his independence. Of course, the METI minister had made comments that, you know, we're going to have to think about what the impact of raising interest rates could be to move away from the ultra low interest rate policies that the Bank of Japan has been pursuing, but that they have to get the markets ready, to get households, to get businesses ready for what could be a shock, that money may not be as cheap anymore. So I think Ueda is really trying to hold the line in his independence. And of course, the METI minister followed up by saying, yes, I recognize the central bank's independence. So I think he has a tough job, and he's a bureaucrat. He'll do what he has to do, but I don't think that he'll be shocking and awing us at this point.
Mm-hmm. You mentioned the strong dollar and how that's something that obviously UEDA must be very mindful of. Last year, we did see the government intervene when dollar-yen went past 145. We've been hovering around those levels for a while now, and we haven't seen any real evidence of intervention. Is actual interventions more of a political or economic decision for Japan?
That's a great question, and I think it's in some ways a political decision. Kishida has managed to stay in power, but there's always that effort. I mean, Japanese prime ministers have usually historically low approval ratings. I mean, ones that would make our leaders blush at least we're not down into single digits. But there probably are some political moves. But it's also to help boost the domestic economy. I mean, households are struggling. Small businesses are struggling. It's great if you're a Toyota or Mitsui who's really focused on export-led development, but that's just not the case for households. So I think that there is a political element in this. I think there is a frustration that the yen is so weak against the dollar. And the hope of what could help boost Japan in having a weak yen really haven't come to pass. Having tourists post-COVID, we're entering the winter season here in the U.S. and in Europe, and that may really tamp down on travel to Japan.
So very quickly, Erin, within Japan, is there demand or a push for an exit from the negative interest rates regime that they're under right now?
I think there's a lot of caution around this. I think that there's a real sense that there's a fragility here, and it's really hard to move from a negative interest rate policy to one that's going to start making money more expensive. We've seen it here in the United States. Once interest rates go up, it really changes. Yeah, exactly. It really changes household decisions. And I think that that's a real challenge, compounded by the fact that there is very weak demand, an aging population, and the food and energy prices don't seem to be going down in the near future.
Erin, a great conversation. Great to catch up with you. We'll talk again soon, I'm sure. Erin Murphy there of the Center for Strategic and International Studies. A look ahead to a big BOJ decision coming in just a few hours' time. One of the big things that the market will have its eye on over the next 24 hours. We'll catch you up on what else to watch tomorrow as well after the break. This is Bloomberg.
Another day in the book. Let's look ahead to Friday on Wall Street. Tonight, we're going to get a decision from the Bank of Japan. Governor Ueda is expected to keep the interest rate policy unchanged as he has been. Of course, Japan has negative interest rates. Investors and the market will be looking for any commentary that he does make on changes to the yield curve control program, along with any commentary on the yen, which is currently hovering at a 10-month low versus the dollar. And we get global PMI numbers tomorrow in the United States. It'll be at 9:45 a.m., 15 minutes after the market opens. We're looking for contraction in manufacturing and growth in the services industry. And because the Fed has held this meeting and decided to do nothing with rates for now, but did change its forecast, we do get a lot of Fed speak. We've got Lisa Cook, we've got the San Francisco Fed President Mary Daly. We've also got Neil Kashkari of the Minneapolis Fed speaking. And all day tomorrow, the UAW will have a Facebook Live event Friday in Detroit where it will likely discuss whether more plants will join the current strike. That does it for us. Balance of Power is up next. This is Bloomberg.